I'm on Eric Hargrave on Twitter. So my strategy is I'm a mechanical trader, so I don't actually have any control of my trades. I've been trading since April 2017. So it's been consistent since December last year. This month I've also been consistent as well.
That's awesome. So what got you into trading?
I actually wanted to have a little bit more consistency in my life. I just wanted to be able to quit my job. So when I was younger, I actually moved overseas, been working for myself for the majority of my adult life. When I came back from overseas, I ended up landing another sales type job and just kind of found myself doing the same rotation over and over and over again. Started reading a lot about Rich Dad Poor Dad, Robbie Kiyosaki, found Andy Tanner, who actually teaches options trading, and just wasn't able to do options at the time. So through education about trying to figure out how to do trading that I could do, I ended up finding Tim Sykes.
That's awesome. And do you consider yourself a Timothy Sykes student?
I do. So I actually signed up for the Penny Stock and Silver. I was actually in that course for about 2 months. When I was doing that, I also paid for a couple of DVDs from Tim Sykes, such as Trading Takers #1. On that one, I also found out that Tengar Tani also learned from Investors Underground. So I kind of did the same thing that he did. I went over to Investors Underground for 2 months, learned as much as I could, but mostly I paid for the DVDs. I canceled both my subscriptions, and since then I've been pretty much solo.
That's awesome. And so I know I follow you on Twitter and we talk pretty often, and your favorite strategy seems to be that ABCD pattern. Are you going over this in your slides?
I am. So I'm actually got a couple of examples that we can go over in my slides. I also have some examples that I've been saving. So in my slides, the slides mostly discuss why I'm a mechanical trader and how it actually helps me being profitable and consistent in the way that I trade, and also why I think it could help a lot of other traders. So
perfect. Well, I will let you get into your slides.
So a lot of traders think that making money as a trader is primarily a function of analysis. Over my course of years of actually learning how to trade, I find that's further from the truth. We actually use analysis to determine what a probability is based off of our edge. The outcome of that is undetermined. It's completely random. There must be a way to trade without taking losses. That was something I also used to think a lot about. Well, these other people that's trading, they're more consistent. They got to find some way to actually be able to be identifying an edge or some sort of pattern in the market that they can almost always win money on. After watching like Mariana and Jack and all them, and I've gone through a lot of their probability accounts, they do take losses, but the biggest difference is I would hold on to losing trades and let them go way out of hand. So that's the next one is I have trouble getting out of losing trades. I think a lot of new traders have that problem when they get into a trade, they start to average down, try to reduce their position, but they don't want to admit that they're wrong on a trade. So that's why mechanical trading for me actually makes it a lot easier. I also used to have problems planning trades that I never executed and executing trades that I never planned. So with my patterns, I'd actually go out at night and I would, kind of create a watch list. And when the market would open, I kind of completely forget about all the research that I did the night before. And when something would just pop up, there's the top exchange gainer, I just end up randomly trading it. Sometimes I make money, sometimes I wouldn't make money. Over the course of time, I end up losing more money than I was actually making.
Okay. And so I know that's something we've been talking about is how to get used to cutting losses, when to cut losses. Being a mechanical trader, you're still taking losses. So did you ever find a way to trade without ever having to take a loss?
No. So over a series of trades, I'll make more money consecutively than I'll be losing. A lot of it comes down to using the chart analysis, which we're all pretty much technical traders. We know where to enter, when to cut losses. Mechanical trading basically means the market's either conform to my trading setup, my plan, or it's not. It's either going to reach my price sell target, or it's going to get me stopped out for a loss. Either way, I can't change anything. Once I'm in that trade, I have to do what it's going to do.
Okay, so you're mechanical trading. You're not just taking a profit to take a profit. It has to hit your target, or else you're going to take a loss if it
That's
stops
right.
out, or if it's in a range, you wait for either it hits your price target or you're going to get a loss.
That's right. Yep.
Okay, that's different, because a lot of traders, if they are in the money, they're usually trying to lock in some sort of profit along the way. You don't do that.
No, I don't do that.
Okay. Um, so are you noticing more success this way, less emotions versus not being a mechanical trader?
I do. So I actually find it's a lot easier for me to trade because before I get into the trade and every tick either up or down would create some sort of emotional response. So one of my biggest problems that I realized in the past was that as the trade was going in my favor, I'd always want more money. I have the ability to take a very small position size and take a massive amounts of percentage wise out of the trade. And as it's going higher, I want more and more and more. And realistically, no trader knows what's going to happen in the market. There's no way to identify whether or not the trade's going to go up 100% on the day or 50% of that day. So no matter how much technical analysis we learn, unless we're actually the people who's making the markets move, we're really dependent upon other traders to make it profitable or not. And that's one of the things that I've kind of learned over time.
Okay, and so how long have you been a mechanical trader for?
I actually started mechanically trading since December. So since December, I've been every single month consistently profitable. Last month, I had a little bit of a drawdown, not because of the trading, it's because I stopped following the way I was profitable. I started becoming more confident in the markets, more confident in my ability to cut my losses. And when I started going against the way that of a mechanical trader, I started taking big losses because I have a problem with my losses. Once I went back into mechanical trading, I ended up making back more than half my losses in 2 weeks. And then this month, even though it's a really slow month, I've actually been consistently profitable.
That is awesome. So how did you figure out, like, how did you hear about mechanical trading? Because you're the first person I've heard mention this. Now, I've heard of automated trading, but not mechanical trading.
So I actually found out about it from Stephen Johnson. It was one of the Steady Trade podcasts. They were doing the book review of Mark Douglas. So he was actually one that were doing one of the book reviews. I don't remember the book review that they were doing, but I was interested in it. Trading psychology is a huge part of trading. So I downloaded it and listened to the audiobook like 4 times. After listening to it, I was like, this definitely has some sort of merit to it. So I went online and just scoured everywhere I could about, every single Mark Douglas seminar I could find and just did everything I could. Then eventually I ended up finding Paula T. Webb. She ended up leading me to 2 other books that I've read. And they kind of teach the philosophy of probabilistic mindset, actually how to associate the markets with an outcome that's undetermined. As traders, we tend to associate each individual trade as this trade has to be profitable instead of going over a series of trades. I don't know which trade it's going to be profitable. I could have 3 winning trades in a row and then 2 losing trades, but we don't know what those series of trades are going to be. So the way that I trade is in a 20 to 25 set trading style. So I'll trade based off of the rigid criteria, and I won't change that criteria during a set. Between 20 to 25 trades, I'll aim for a very specific percent target, and either the market hits that percent target or takes me out for a small loss.
And how did you determine those percent targets, and how do you determine your percent loss or dollar loss?
So I determine that based off of the charts. I don't base it off of a percent. So this right here, to give you an example, is my tracker. So over here on this side where it says OTC average. So based off of every single trade that I track trades that I've been in, and I also track all the OTCs that I'm not in. In order for me to get a higher probability of what could happen in the market, I have to track everything that presents itself as my edge. I trade breakouts and ABCD patterns. And so when the ABCD pattern forms, I end up will buy it, place a risk based off of where the chart's at, and put my average on there. So that 57%, I usually aim for 50%.
Okay,
So,
and
right here.
I don't see your, now I see your cursor. Okay.
Yeah. So where it says 53% loss, that's not accurate. I am currently swinging over over the week in 2 separate trades. That's why these 2 boxes down here are actually empty, and they say 100% losses. I'm actually swinging over the weekend IPSI and also SYSX.
Okay, and is it a specific chart pattern that you're looking for? Do you track which chart patterns? Or, oh wait, I see over here on your
Yeah,
left.
so I track
ABCD
all.
breakout.
Yeah, so I track all the patterns. I predominantly only do ABCD patterns and breakout patterns. So, like, I track everything, where my entry is, where my exit is. So this is PADM. Some of these will actually, I tend to actually hold more overnight than I expected. I thought most of the time I'd end up getting to a trade and getting out very quickly, and that would be it. But oftentimes I'm actually holding on for multiple, like for at least 2 or 3 days at a time. So because the percent target that I'm going for is an average of the possibility of that one move. So like for instance, this right here is INVU. I traded this one. I bought it down over here and I got stopped out pretty fast. The chart kind of fell, hit my stop. I had a little bit of capital left. I bought back into it on VWAP, reclaim, and I risked down below, down here. And so all I did is just let it work.
Yeah.
I was actually looking for a 52, I think it was a 52% price target. And I actually sold it a little bit early. When the next day it actually came down, but it never hit my risk. And it kept going and reached my price target up here.
Okay, so how come you sold early if that violates the mechanical trader?
Convince myself, I guess you can say, that it works. It's really hard to kind of, like, especially the last month, I was able to take consistent profits over and over and over again. This month, I started hearing a lot of people on Twitter and a lot of people online saying the market's really heavy. This is really this, and I do see that. I'm not saying that I don't see that, but when my edge presents itself, I have an obligation to buy, regardless of what's going on. So every single time the ABCD pattern happens, I end up buying it, and based off of what's happening in the markets right now, 2 or 3 ABCD patterns will reach my price target. One of them will fail. And so I do think a lot of that was, people in the markets were kind of, or people on Twitter and social media was kind of preventing me from actually going, okay, I know this is what actually works. So I ended up having my winners a lot earlier.
So are you still kind of keeping an ear out about how other traders are influenced by this current market change? Because during this hot market of like 2020 and the beginning of 2021, I was having troubles keeping up with so many hot plays. But now with the markets being slower, I'm able to focus, and yes, there's not like 20 stocks going parabolic in a day, but you still have the nice singles out there. Yeah, sometimes you have to wait for the pattern to form, and then, oh well, if you miss that one perfect setup, but the patterns are still working out per Timothy Sykes 7-step framework. So yes, there's not like hundreds of plays or quite a couple hundred plays in a week, but there's still consistency. So recognizing that, are you now waiting for your price targets to be reached, or are you?
I am, yeah. So Monday, I actually took 3 trades. 2 of them made me 60%. So on Monday, I traded, let me see, what was Monday's date? So the 12th. So on the 12th, I traded ADGO. So ADGO. Let's go back 15 days. So I got word on this one because what I do is I actually look at the 3-month 1-day time frame to actually determine what their overall trend is. So this right here is like the #1 pattern on Tim Sykes framework, and then it kind of just had this little bit of consolidation. As soon as it broke out above this area right here, I ended up buying it and swinging it and took 60%. So I ended up buying it at 0.00339 and sold it at 0.0055 and took 62.24% on that trade.
Incredible. That is awesome. Now, do you consider that a home run or a single like Timothy Sykes preaches?
Well, that's a good question. So throughout my trading career, I've heard a lot of teachers and stuff like that say, well, you want to aim for singles and not home runs. Well, I always have the problem going, well, what is a single versus a home run? And to me, a home run is going beyond the probabilities of your pattern. If your pattern states that you have a possibility in the current market conditions, whether it's now or in the future, if you're sticking within those parameters, to me, that's a single. If you're saying, the odds are that there's a 50 to 60% chance of this pattern doing this, and you're going for 70, 80, 100%, then that's considered a home run. So the probabilities of actually hitting your target is extremely low compared to just saying this is the average move. Now, even with this current market right now, I can go for a 50% profit. If somebody wanted to be a little bit more conservative and have a lot more consistency, they could aim for 20%, 10%, 15%. And the chances of that hitting their price target is much greater than it hitting my 50%. Out of all the trades that I trade, 2 out of 3 will work. 2 out of 3 will actually hit my price target, and 1 hole won't bet.
That is awesome that you touched that point, because exactly, I sometimes struggle trying to figure out what is a single versus double or home run. And it depends on the market, depends on the pattern. And that's what a lot of traders talk about, is it's situational. And some traders I'll see taking like a lot of 2% profits, or maybe try to go for 10%, 20%, and then over 30% be like the doubles, and then over like triples and stuff like that. And a lot of people just try to take the 10%, but sometimes it doesn't even spike 10%. So they get emotional and they'll just try and lock in profits. And then you end up selling at the bottom before the bounce. And so it's cool that you actually figured out the probabilities of the patterns to make a great price target within the range of that pattern. At least from, that's what I'm understanding, right? That's what you're doing.
Yeah. So I use the data that I collect to determine what the possibility is. Not every single trade is going to work out. So DSCR, I also bought on Monday. I placed my trade at 60%, which would be 15.2, so 0.152, which was right up here. And as you can see, it never got there. So based off of the mechanical trading, I have to do whatever the chart's going to do. So as long as it's within my OCO orders, because I actually put physical sell orders and physical stops in the market, it's either going to reach that price target or it's going to come down and get me stopped out for a small loss. I did end up taking a loss in this trade. It turned out to be a $28.11 loss, so 3.93% loss, which isn't bad. If I'm aiming for 50%. I'm making significantly more than a 3% loss or 4% loss on that. So even though it's a loss, later on the chart will present itself with a pattern. If it breaks out over here again, I'll get back into it.
That's incredible. How do you deal, and by following this mechanical trading, you are not emotional. You don't see that it went just under your target and be like, oh man, I should have locked in something along the way?
No, because there's times where I've actually seen it ramp up, do all this stuff, kind of do choppiness, come straight down, almost get me stopped out, ramp all the way up and hit me at my target price, and then I'm out. And the whole time, the patterns I've learned is basically stating that there's a higher probability of something happening. As a trader, we think that the patterns is a higher probability of your trade being profitable, and it kind of isn't. It's just something could happen during that pattern. So when the pattern presents itself as a breakout, I'm like, okay, well, the breakout occurred. It means that there's a higher probability of it keep going. Now, some breakouts will run 2, 3, 4 days in a row. This one ran one day, fell, bounced. So I just have to base off the probabilities. So all it is it's either going to hit my price target or it's not. And the thing is taking losses as a trader, it's a given. You're going to take losses. It's just about mitigating your losses to being smaller versus saying I have to be right in this trade because it is uptrending again. It just, I don't know that's going to happen. We never know what's going to happen next in the markets. And so that's why I completely leave it. I just place it out the probabilities, place my trade, and oftentimes I'll just walk away and take care of my child.
That's awesome. And you can trust your stop losses, because I've heard a lot of traders say that market makers will see all the stop losses, trigger it, and then bounce the stock right back to that price. Have you ever had that issue?
I do actually track that. I do actually track of how many times it comes to my stop and bounces right away. So in the case of this one, because this is why I brought it up, when it comes down, gets me stopped out and bounces up the next day, that's just the chart pattern. I don't consider that any sort of problem with the edge or anything like that. If it hit my stop loss and then bounced right away and just kept going up, then there's something that's going on. So I do actually track that. Out of this entire time of me trading, I've had it happen 3 times.
That's not bad.
So the possibility of that happening isn't that good. But what I've also learned is it comes down to, am I placing my stop at the right level? Sometimes I might be placing my stop too close to my entry, and that could be based off of the dollar amount that I'm willing to lose, or the chart. Sometimes with these sub-penny stocks, a small move is a big move. A small move in the chart is actually a huge percentage. So there's sometimes when I enter into a trade, I'm based off of what the chart pattern says that it has a higher probability of failure. When I actually get the mathematics, it's a 10 to 15% loss. And it's up to me to determine, am I willing to take a 10 to 15% loss to potentially make 40 to 50% on the trade?
And that's not bad risk reward.
It's definitely not. And so there's times where I'll do that, place it, and I'll take a slightly bigger loss, or oftentimes it actually works out. Just depends on what's going on with the markets and depends on what's going on with the trade. So on this trade, I entered in here, pretty much right down here, and my risk was actually, let me go to a bigger time frame.
And thank you for sharing all this. This is incredible.
No, you're welcome. So I literally entered in right here on this candle, and my risk was right here. So as long as it's actually not going to violate that area, I'm fine to be into it. And so I placed my risk here as long as it didn't come down. So I got it at 8545. There is a little bit of slippage. The way I view it, though, is when a trader's actually trading, there's really no way for them to actually be on the dot 100% of the time. If you have a risk, let's say $5, and it comes down to $5, there's going to be a slight seconds of hesitation before you decide, I'm going to enter this trade. A lot of the times they're going to be like, well, I want to see if it goes a little bit below. And if people do what they're supposed to be doing, using limit orders to get in or out instead of using market orders, in order for it to actually fill your order, it has to go through your price. Right. So there may be a little bit of slippage with there anyways. So generally, if I'm trying to get out at a certain price, there may be a few cents or fractions of a cent if I'm trading sub-penny stocks that I'm going to get out. But it's still within that risk tolerance that I'm looking to get. If I place it outside of the level, so let's say if I place it like, if I'm trading this and I want to get in around here and I want to actually risk down here, if I put my stop like down here and the market goes parabolic, then yeah, it's going to actually, it could potentially get me out for my bigger loss. And a lot of people may actually learn, they end up learning from teachers who say, put your stop at 5% or 10% or some arbitrary number that really doesn't have any relevance to the chart pattern. So the closer I keep it to where my risk level is, so if I was going to risk, like, if I'm into this trade and I want to risk off of here, I'll put it right below this candle, like right there. The tighter I keep it to where my actual level is, but just below it, if it hits that, there's a little bit of hesitation in the market that's going to hit it, kind of hesitate, and then drop it down further. And I find that in that hesitation mode is where it actually get out. And then oftentimes it just keeps going down.
That makes sense. Yeah. I tried that for a little bit where I was risking specific percentages instead of risking on key supports, and that just didn't work. So now I look at the key supports in the chart pattern, and that makes a world of difference. Then I size in according to that risk.
Yeah. And so like when I'm trading, I do the same thing. I'll look at the key support and resistance. Here's another pattern. It's kind of a one and done chart. and it had a breakout. So I entered buying into it. Down here as soon as the breakout happened, and my risk was actually not really good on this chart because I have to do 5 days. Let's see if I can reduce the time frame.
And just for the viewers, what are all those lines? I think I recognize VWAP, the higher VWAP and the lower VWAP one that's on Thinkorswim, but there's some that there's more than 3 lines. So what are those extra ones?
Yeah, so the blue one down here is VWAP. These ones are RSI. I really don't use them. They're just there. The purple lines down here, yeah, I actually watched one of Jack Kellogg's videos on Propoly, and he used this tool in Thinkorswim that basically is just for the people who use it. Is this one right here. It's a price level. So I use that to determine key levels in the chart. If it breaks out above those, I can risk off of those. Because when I was trading before, I put, these trend lines, so like this, and I'll have it go across my whole screen. But as it's trading, you kind of become numb to what those little things mean. You see a line, you're like, okay, well, I don't know what that is. So these purple lines are basically where I see key levels, because it's kind of more of an art. It's not really exact science, as Tim Sykes and a lot of other people say. So the purple lines are where I'm risking off of, or where there's key levels in the chart. The trend lines I'll have on there for pattern recognition, and that's about it. So if I'm trying to identify a pattern, I might drag the trend lines to see potential. Is this my pattern or is it not? And that's all I use them for. And then these bars right here are just volume bars.
Perfect. Thank you for explaining that. A lot of traders use different indicators, and for Thinkorswim, I've been recently affiliated with Scripts to Trade, and they write the code for custom indicators that help traders recognize abnormal volume. I don't know, there's so much stuff, which I'll actually leave a link in the description, and discount code TESSA10 for anyone that's interested in Scripts to Trade, checking out those indicators. But that's awesome that you use those. And how do they help you trade?
So that's a good question.
The VWAP and stuff like that.
So the VWAP, I've learned over time that if an ABCD pattern forms under the VWAP, it has a higher probability of failure. So if I buy it under VWAP and I'm anticipating breaking over VWAP, it may go over and then under and just keep fading off. So when I'm buying it, I want to make sure that it's above VWAP when I purchase that pattern. I don't want to actually buy into my pattern unless it's above VWAP. There's some times where people will anticipate, like if it comes down here and it bounces off of the previous day's high, it may have a chance of bouncing back up to VWAP and continue getting on like this chart does. But that's not my pattern. I wouldn't trade that because I don't have the data to back that up. I also don't have any way to determine what the potential of that is. I'm also a little bit better at seeing specific patterns in the market. I do think that the market has an ability to speak to different personalities. And a lot of times traders try to conform their personality to a mentor that they idolize, or somebody that they're like, hey, I want to be just like that person. And I did the same thing. I want to do certain patterns that Tim Sykes does, and I'm horrible at it. I try to do the same thing that Tim Bertani does, and I'm terrible at it. So over time, I started learning the patterns that suit my personality. I'm a little bit more laid back, so that ABCD patterns take a little bit more time to develop. They also take a little bit more time to work, and that's why I like them. I can place more words in and just let them do its thing.
That's awesome that you mentioned trying to emulate the other top traders, because I think that's what every new trader does, especially when they find a guru that they're learning from, because they don't know their personalities, they don't know themselves as a trader. And even I began that way, and I'll even still learn from other traders and how they trade. And then I'm learning to adapt it to what makes me feel comfortable. So that's awesome that you mentioned that, and you're figuring out your personality for these patterns.
Yeah. Yeah, it's a lot of trading is, everyone knows that trading is psychological. It really doesn't take much effort to place a winning trade. You literally know absolutely nothing about the market and find yourself in a winning trade. It's harder to be consistent in markets and have a consistent income from the markets. And that's where a lot of people who are successful, I do think that they have a hard time vocalizing their success because over time they had to learn these things. They think that just one day they had an aha moment. But a lot of it comes down to a series of events that actually change the way they think to become the profitability that they are. A lot of the times people that are successful, like Mariana, Tim Connie, Jack Kellogg, Kyle Williams, all of them, they probably have a specific upbringing that most other traders don't have. Most of the traders do have some sort of a self-evaluation, how they actually view themselves. Do they actually find themselves worthy of making money? Do they actually feel good about themselves? And people like Mariana, she's mentioned in some of her podcasts recently that she grew with a strict discipline in her life before trading, and she also has a good support group. Unfortunately, a lot of traders don't have that. So when we're in the trades, it could be possible that taking a loss in the trade could actually trip us into a state of mind of where it reminds us of every bad decision we've ever made. And so trading kind of can put you in that rabbit hole of psychological kind of turmoil where you go through a series of losing trades and it's really hard to get out of. And then you have to kind of toughen up and get back into consistency, and then you trip yourself back up into the same thing. And it's kind of boom and bust cycles over and over and over again. So I was a boom and bust trader. I've actually identified certain behaviors that prevent me from doing that again, which is why I stick with mechanical trading.
And did you learn all this from specific books that you've read to identify these behaviors?
I did. So a lot of this I actually learned through Mark Douglas and Paula T. Webb. Some of the books that they actually have on the website. Paula website is paulatwebb.com, in case anyone's interested in that.
I'll leave a link in the description for that website.
Yeah, they are actually doing some renovations to the website. So some of the books that's there, the links don't bring you directly to Amazon, but keep checking because I've talked to her a few times. They're actually updating everything. So that's one of the biggest things that's actually helped me. They actually have some books that's called Become the Disciplined Trader and The Complete Trader, which those two are actually written, Trading the Zone and the other one, they're not actually designed for new traders. They were designed for people who have been trading for a long time, 10 plus years, and they kind of already understand the mindset of how to become profitable, because if you've been trading that long, you have had some success. But as new traders, we don't really realize the probabilities within the market. And even people who teach it, they understand the probabilities, but they may not understand how to teach the probabilistic mindset. And so when people get into a trade, like let's say Tim Sykes, he knows that there's a potential of that trade failing. Right. And so he teaches to cut losses quickly. As new traders, we don't have the ability to actually do what's in our own best interest for our account and for our own mental health. So when we get into a trade, some traders like myself will end up getting to a trade thinking this trade has to work because other previous trades did work. And our brain has the ability to associate this now moment with some moment in the past. You've probably seen on Twitter a lot of people saying, hey, this chart formed just like this X ticker that already happened. It's going to run X amount of time. And it doesn't happen that way. And each trade has different players in it. There may be people that was in the similar trades that you were in previously. And there's also other people who has bigger or smaller size. Depends on, did they make money in the past trade? Did they not make money in the past trade? And, looking at stocks to trade, they've had some great guests on there, like JJ, they've had him on twice. There's a lot of market manipulation. And the only way a retail investor is going to actually make money in the markets is if other people make the money.
Episodes of the Steady Trade podcast, which I'll also leave a link in the description, are incredible and very resourceful about the market makers and stuff like that. So thank you for mentioning it.
Yeah. And see, it's that type of stuff that I've learned that's kind of reaffirmed that even if I didn't have a physical stop in the market, I still have no control of the outcome of the trade. JJ talks about people manipulating the markets, painting the chart on the screen to entice traders to buy into the market and to buy into the chart. So it's like, well, if that pattern is consistent and there's a possibility of it winning 70% of the time, and I place 20 trades, I don't know what the sequence is about actually being a profitable trade versus a losing trade. So all I do is I buy every single one, and I just keep my risk small, keep my position size small, and over time, that probabilities will work out in the end.
Yeah, and that's awesome. So you keep talking about taking small position sizes. What do you consider small? Why are you taking them? And do you plan on sizing up as your account grows?
Yeah, so that's a good question. So a lot of the other people I've talked or seen other people on YouTube, they don't actually talk about dollar position size or percent gain. My average trade is between $250 to $500. That's my entry. My profits on that is 50% this month, 40% last month. So I'm gaining between $150 to $200 per trade off of that small of a size. The way that I actually trade, as my account grows, I'll actually be using 1/4 to 1/3 of my total account for the position. So that's $250 to $500 based off of what I see in the market. If there's a lot more play that's happening, and I will have that ability to see that because I'm tracking all the data. If there's two ABCD patterns in the market, that means one of them has a higher chance of failure. So I'll go in with maybe $500. If I only have two of them available on that day, I'll buy them. I'll just divide that amount and buy them on that day. If the market is being more hot and there's a lot more ABCD patterns forming, and let's say there's 3 on the day, that means one of them has a higher chance of failure. So I'll reduce my position size to maybe $300 to $400. And I'll keep it within that thing. So that's how I actually determine based off the size. I also find that a lot of times when people say, I'm comfortable with the size, oftentimes they're not. I used to say the same thing. I've traded up to a $10,000 position before, and I've actually had to reduce my position size down to $150. And I'm working my way up from $150 position size up until it becomes absolutely meaningless. Every single take of the market, it shouldn't have an emotional response. It shouldn't allow you to be tricked into a state of mind of, I want more money, or I'm going to be afraid of losing this money, because that prevents people from actually seeing clearly what the market has available. And so I do think that when people's like, I'm comfortable with this, $1,000 position, $2,000 position, and they're taking a 2% price, profit, why? And if they're going, well, I got it because I was afraid the market was going to come back down. Well, that fear can actually make you see something that's not really there in the market.
Makes sense, but that's where if they're trading the same pattern all the time, they know their personality, they're used to it, then ideally they'll be able to recognize when the level 2 isn't acting the way they want. And this is for more advanced traders that have been more familiarized with the level 2 and the way the patterns they form, because Tim Sykes will cut losses quickly where he might have a 2% profit, but it's a scratch because he knows how he wants the pattern to perform. So he can take that 2% without it playing games. Yes, sometimes the stock will go up later, but also there's times where it'll completely fail. And it's a good thing he recognized that and got out when he did.
Well, that's true. And the trading the way that Tim Sykes does, and he even admits that he's a scared trader, there's nothing wrong with that. As new traders, we cannot be trusted to do what's in our own best interest for our accounts or for our mental health. So if Tim gets into a stock and he can recognize, hey, I'm uncomfortable with this, he has the mental fortitude to say, there's something wrong in the market, I'm going to exit the trade. Most new traders don't do that. Most new traders will actually negate the risk out of the trade. Most new traders will say, I'm going to enter in this trade because it's gonna work. And when it doesn't, it trips into the state of mind where they're like, hey, I have to hold on. Or they go into, like, let's say a $1,000 position, a 10% loss is $100. If you have a $200 account and you get into a loss and it all of a sudden just moves down 10%, you're down $100, you may not be willing to cut that trade, which means your size is too big for your mental state of mind to actually be able to say, hey, I'm willing to cut this loss. And there's times where I've sized up in the past and taken a $200 loss, was like, oh my gosh, I don't want to do this. And I have taken up to a $1,000 loss before. So it's being able to be, does this position make me scared or make me emotional in any way? If it does, the size is too big. If it's going up,
that's great. Yeah, exactly. Because a lot of the new traders, they have no idea what's too big of a size because they've never experienced the emotions of trading. So they're
Yeah.
like, is my heart supposed to race like this? And traders talk about being robots. So how do I become a robot? And for you, it's having smaller size and doing the mechanical trading. So for traders who are just now hearing about this, how can they research into becoming a mechanical trader? Resources, just anything. How did you find it? Just any information on that?
So after learning a lot about Mark Douglas and the way that he teaches his information, I kind of realized pretty much everyone you learn from is a mechanical trader. They just don't realize it. So the definition of a mechanical trader is the market conforms to your pattern or you doing nothing, absolutely nothing. So using the penny stocking framework that Tim Sykes teaches, you actually have a breakout pattern. So you don't anticipate a breakout happening. You wait for the breakout to actually happen before you buy into it. That's a buy signal. And as soon as the breakout confirms that it is broken out, you buy it, you place your risk, and you let the trade work. If the ABCD pattern is forming the market, I have an obligation to buy. Same thing with the dip buy pattern. You see the dip buy come down, you can actually see the level two is happening. There's a lot of hesitation in the market going, especially if you're taking a lot of losses in a row. If you're taking a lot of losses, you may actually think, well, this one may not work out. So you may hesitate, and then it works out just fine. But because you don't know what series of events are actually going to be profitable and ones aren't, every single time that pattern comes up, you have an obligation to do it. And one of the things that got me really consistent was over Christmas time. I actually got the penny stocking framework by part one, part two for Christmas. So I actually started just watching those over and over and over and over again. I've probably seen them both 10 times each. And so I started noticing that I was already trading the pre-stocking framework. I just didn't realize it. And a lot of the trades that I was taking big losses on did not follow that framework. So now I only trade the stuff that's on the framework. And so the framework to me is basically human emotion painted on the screen. I look at the charts and the bars and the patterns as what do people actually think at any given time in the markets? Are they greedy or are they fearful? Because each individual only has one reason why we're entering into a trade. We want to make money. Every trader who places a trade wants to make money. Nobody goes into the markets thinking, I want to lose money and make somebody else money on the day. And even though there are manipulation, it doesn't mean that you can't make a profitable trade. So mechanical trading, these people who teach like Tim Sykes, they are actually mechanical traders. The difference is there's a mechanical form of trading, which is what I do. There's an intuitive form of trading, which is what Tim Sykes does. Tim Sykes over time has actually had the ability to market information, has the ability to actually say, I've seen this pattern multiple times. I know what I feel comfortable with and what I don't feel comfortable with. And all he does is wait for those patterns to set up over and over and over and over again. But because he has the discipline over a duration of time of actually learning how to do the markets, he can actually cut his losses. Most newer traders, they don't have that. You probably experienced when you're paper trading of how you can actually grow a small paper account into a large paper account, and it seems very effortless. But when you try to do it in real life with money on the line, it's really hard. That doesn't mean there's a problem with what you're trading. It's a problem with execution. It's how you're actually trading it. When you're paper trading, you don't have any hesitations or reservations to get into your pattern. You just instantly do it. But when you're trading with money on the line, you actually may have a problem with hesitating to get into a trade, especially if you have a series of losses. If you have a series of wins, you see your pattern, you're going to instantly jump into the trade because you have confidence in what your pattern has done.
Yeah, exactly. And I can actually relate to that because during that hot market, was it in January and February, I'd have to double check on my Profitly or my trading journal, which I use TraderSync, and I'll leave a link for that below too. It was showing me how every morning panic that I dip by, it would bounce for 1 minute and then it'd be a fake out, and I'd get caught in the panic. I'd be trying to exit, but it's too late because I didn't recognize that level two fast enough, that turn to get out ahead of that panic. And so I spent a good probably what 3-4 weeks of just losing, getting faked out. I would adapt and wait for maybe the second bounce, but then that pattern would fail and it would be a fake out. And then when I would wait for two bounces or the two fake bounces, it would just bounce on the first one like it should have done in the first place. And so now with this slow market, a lot of these bounces have been failing, except for the past like 3 days. They've been pretty on point with bouncing the first turn, but I haven't even been capitalizing on the good bounces the past 3-4 days because of my experience with the so many failed bounces and getting stuck in them that I was watching the level 2. I'd call it perfectly and say, hey, this is the turn. Ideally, this should bounce right here, and it'd be a good 10% plus profit. And I don't even bother typing in my trade because of my experiences with the pattern just changing for that little bit, but I didn't like taking the losses. And so I missed out when my pattern has presented itself. So
Yeah.
it's exactly what you're talking about. Versus like when I was paper trading, I grew my account to 7,000, no problem. And I was reviewing those trades and I was taking like 10% gains, 16, 20% gains. But a lot of those were first green day overnight holds on OTCs. Where I was guaranteed a fill essentially, and I didn't pay commissions, and that pattern was working where it would gap up the next day and I was guaranteed a fill into that morning spike the next day. Versus like now with live trading, I have to make sure that I have proper position sizing to cover the commissions, and that's what a lot of traders I talk to struggle with in the beginning, is covering the commissions because they don't know their edge necessarily like you've tracked, or they don't have the emotional stability to have the larger size, and they don't know when to take the profits or when to hold. So I'm glad that you've been covering that.
Yeah, so like when people want to learn a new pattern or a new, edge or whatever they want to call it in the markets, I do recommend paper trading, because what you want to do is what is the possibility. And because trading ultimately is execution, we analyze the stocks using technical analysis to see whether or not our edge is presentable in the market. But what we're actually doing is executing the trade. So I use paper trading to determine, can I identify this pattern, this edge that I want to trade in the market? If I want to start trading dip buys, I'm actually going to be paper trading that. I'm going to track every single dip buy pattern I have. And I want to actually determine from the bounce where it comes from to the top of where it ends, how far of a range is that? And I want to go for the average of that. And, there's sometimes that dip buys, especially in the previous markets, they'll bounce 40, 50, 60%. I'm not going to get the top. Yeah, even 100%. I'm not going to get the top, but over time, as I have data, I'll actually have an average of where that potential would happen. And so when that happens, I'm going to buy that and put my risk on there and just allow it to work. And that's also how I think a lot of traders, especially in the OTC markets, because the only people that's going to be paying for OTCs is if you're in America and you're actually having those type of those fees. Most brokers who actually charge for OTCs, most brokers will have, especially because of Robinhood, free listed stock trades. Mm-hmm. So I'm actually paying $4.95 for my OTC trades. I know because of Robinhood, because of the craziness in the market last year and this year, a lot of brokers aren't allowing you to call them up and say, hey, I want to reduce my commissions. They once were, I do believe in the future when things quiet down, they will allow that to happen again. I think the reason why they didn't is because they have an influx of new traders that if everyone was reducing the commissions, they wouldn't be making a lot of money. And brokers are basically salespeople. They're not there to help you trade or help you learn to trade. They're basically there to take your money away. They, like Tim Sykes says, they want you to trade more. And they make their money based off of the fees and commissions. So when I'm actually trading, because I'm paying $4.95, I'm paying $10 round trip. It doesn't take long for me to be in a profitable trade. So it's like, if I'm aiming for 50% off of the $250 position, I'm easily making my commissions back plus a little extra, and I'm always consistently making more money. One of the things that I also find is as newer traders, they try to keep their percent loss and the percent gains too close together. I did the same thing. I was aiming for 10% profit, and the rest was on average 10% loss. But again, when you think of probabilistic mindset,
And
yes,
okay, so yeah.
yeah. So when I was first started trading for the first year, I tried to keep my win percentage on average about 10% and my losing percentage about 10%. So I was over 10% and 10%. So over time, I'd have 1 month that I'd actually make money. The next month I'd lose money. The next month I'd actually break even. But over the duration of 12 months, I'd either be up a little bit or down a little bit or break even. And so when you're actually trading by saying I'm going to have a 5% price target or a 5% loss target, the problem with that is that there's a higher probability of you just not really consistently making more money. So a lot of traders, I do think, kind of do that. They get tricked into the state of mind of saying, well, this person says I try to do 5% loss, or I do 10% loss, or I try to do 15% loss. And they get excited about what that person are learning from is teaching, and they try to mimic that.
Yeah.
But instead, just based off the chart, if you have a specific pattern that you can identify easily and it works with your personality, and at this level, it has a higher probability of that pattern just utterly failing, just cut it. And I use OC orders because I know I can't control my ability to cut my loss.
What's an OCO order, and how do you place one?
It means one cancels the other. So even though I use Thinkorswim as my trading platform, I don't actually buy the trade from my computer. I buy it off my phone.
Oh, really?
So
is that easier or harder?
It's easier because when I first started trading, I was actually full-time working. And so I'd be doing what a lot of people do at work underneath the desk, trying to place a trade and use my phone to chart it. And sometimes I'd actually have a live chart on my screen. And so I just kind of got used to it. It's a lot easier for me to do it. There's multiple ways to actually place a trade on Thinkorswim. You can actually click down here on the box and it'll actually bring this little thing. You can actually turn on auto send. So, you don't actually have to, there'll be a confirmation box, there'll be all this other stuff. If you turn that on and you click on the level 2s, you can actually just go down here and either place the dollar amount and just say, hey, I want to do that. And there are ways to actually make it so it's manual. So you can actually just say, on this level 2 box, I want to buy this much dollar amount. And if you want to have your consistency, let's say you want to trade $500 until you want to increase your price, you can actually change this to $500 or $200 or $100 so it doesn't change. So that way it makes it a lot easier. There's also up here, I can either join the ask, join the bid, this is to sell, this is to buy. So I can actually just type in the amount of shares that I have here. So if I have a slightly bigger account, or what the dollar amount is, so if I'm on a higher price trade, I'm like, well, I can only afford 30 shares of it. So I can type in 30, need to buy the ask with a bid. And there's that, but there's multiple different ways. But I use my phone predominantly to buy into it. On the way that
sorry.
Yeah.
Can you only place an OCO order on your phone through Thinkorswim, or can you do it on the platform?
So you can do it on the platform. So it says sell custom OCO with brackets. So there's obviously no trade. I don't have any account. Well, actually, let me go on to this one. So this is a trade that I'm currently in now. I actually bought into this, averaged into it because I do think it has a higher probability of squeezing. It's I don't know if you saw this from yourself, SYSX.
Yeah.
I believe it was Thursday. It actually is a micro float stock. I think it has like 500,000 shares available to trade. It's all in Ethereum. So I bought into it. And so if I want to place an OC order on here, I just go, only have 136 shares. So I just right click, go down to custom, sell brackets. I think it might not let me do it because the market is closed.
Probably.
But there is a way to do it just right here.
Okay, perfect.
And so I generally don't do that. The way that it's on the phone, because I do based off of a dollar amount, not based off of a share amount, I can actually go into my phone and say I'm willing to buy $250, and I'll just watch this level 2s and also the pattern. I predominantly don't watch level twos, even on like OTC stocks, because I don't have to, based on the way I trade, I don't have to have very precise entry and exits. As long as it's within a box of where I want to enter, I'll enter the trade. So like if I was to go into, let's see this.
Well, yeah, and you don't need to really pay attention to level two because you're basing it off of the pattern. You have your target, it either hits it or it doesn't.
Yeah.
So
Yeah.
the level two in between is irrelevant, essentially. I mean,
Yeah.
it just seems irrelevant.
Yeah, and it is based off of the way I trade. So I saw this ticker on Friday, and so this right here is the pattern that I like to trade. You have a good morning spike, holds back, and it slowly makes to make higher lows, and it squeezes up towards the high of day. Some people call this the gun pattern. It's also known as the OT swizzle. It's also known as the ABCD pattern. There's multiple different names for it. But what I look for is the first initial part. I don't trade predominantly in the mornings. I find that even breakouts, I'll sometimes have a breakout, pull right back and fade all day. So I usually give the market a good 20 minutes to an hour to actually kind of work its way out. So on this pattern, if I was to enter into it, I would actually see it anywhere within this area right here. I would enter into it.
Yeah, that's where I like to enter too, because Jack Kellogg, where this huge volume increases, yep, right there.
Yeah.
That's usually where he likes to enter, but I like that consolidation risking. Yeah, I like that consolidation spot risking the little bit before that. And to me, that's a good entry. But I also like when it consolidates for a minimum of an hour, because I was watching one of Tim Grittani's DVDs. I can't remember if it's Trading Tickers 1, but I think it's Trading Tickers 2, where he was doing the research. And even if it consolidated for 45 minutes, there's less of a probability that it'll spike versus waiting for just that 1 hour of consolidation where it increases the odds of it continuing higher. Have you recognized that? Have you tracked that?
I haven't. I've been tracking ABCD patterns for several years now. So I have a lot of data on them. Depends on the market. Obviously, everything's dependent upon the market. Right now, 2 out of 3 ABCD patterns work. One of them. In the past, in like 2019, you'll actually have, probably 3 out of 4 will be profitable, or they depends on how much they're actually running. Like if this was like, if it ran out, came down, kind of consolidated and kind of did this, it may hit high of day where it was previously and just fade. But it depends on when you're buying it. Like if you were to get this from, let's say, from here and you sold it right there, that's probably a 10% move. I mean, this is, a cheap stock. That's probably a 10% right there in the chart. Now on this trade, this is actually a 58% profit. So from buying it here to running up here, you have a potential of a 58%, which is why I base off of probability. I would actually buy into it and sell at 50% price target. And I'll just let this whole thing run. So I would buy during this consolidation, and I place my risk right below here.
Yeah.
I've seen it a lot of the times. Probably just right below this red candle. I'll either go right here, just slightly below, or if I really wanted to, I can go slightly below that green candle right there.
Yeah, exactly.
And that might be a 10 to 15%, maybe 7%. I can actually do the math on it right now.
Right, but if you're sized in appropriately and if you have a set dollar risk, it doesn't matter.
No, it really doesn't. And as long as you're actually sticking to a plan of entry and exit. So if I was to hypothetically buy at 14.6, and so if it got stopped at 13.3, that right there is an 8.9% loss.
Right.
With the potential to make a 50%.
Yeah, and that's incredible
that's
risk to reward.
Yeah. Now I never traded this stock. I was actually tied up in the other 2 trades I'm currently in, but I track it because that does affect my data. And as I get more data over time, when I do my next sample set of trades, I'll actually be able to base it off that. So right now I've almost completed my first sample set for the month. And then when I start my next sample set for the month, I'll be basing off of that data. As the new months come around, I base off the previous month's data. So if last month said that I had a potential of 40%, I'll actually aim for 40% until I get new data to tell me otherwise. As data sets come in, I evaluate that, and that's where I base everything off of. So on Monday, my data said that I could aim for 60% price target. Placed 3 trades, 2 of them hit 60%, 1 of them fell.
And so that's incredible to know. So say someone's inspired by this video and they want to start trading the pattern, and ever since Gratani, everyone loves spreadsheets. So how long did it take you to develop your spreadsheet? And do you have that, just the one that you showed me, or do you have multiple? Well, obviously you have years worth of data.
So I have all these down here. So my spreadsheet's divided on months. So the way that I trade is I divide everything per month. Because if you're basing this current market this month off of several months ago data, it's irrelevant because the market changes. So you have to update your data as the market changes itself. So each month is a completely new data set. I actually started creating this spreadsheet because I paused Stephen Johnson's video, and I just try to see what relevant information he uses. Now, some of the stuff, it's kind of irrelevant for my pattern, but I still keep it because it's good to know. I know that with the higher flow, it does take more time to reach my price target, but it still does reach my price target. You can see with the listed trades, I have an average of a 20% profit potential. Because it says 2303, I never go for this exact number. I'll round down. So if it's 57, I go to 50. If it says 65, I'll go down to 60. If it's 20, I might go down to 15. Maybe if it's 23, I might go down to 15 or 20, because then it gives me a higher probability of hitting that price target overall. Because these averages are the potential of where it's going to reach the exact top, and you're never going to top take. And there's a likelihood that even if you do get the top, you may not get a full fill, and you may get partial execution. And as it's going down, because the way that I trade, you can't get out. You just have to wait for it. So that's why I do average down, or I do actually round these numbers down. So it's taken me years to actually do that. The data that I actually collect on this is I want to know what pattern I'm actually trading. So you can see here, I predominantly trade ABCD patterns, breakouts, tried a few dip buys, not very good. A random trade is basically a trading error. It's sometimes when I think an ABCD pattern is forming and it doesn't, and I get in too early, and then I take a loss. And it never actually forms an ABCD pattern. Or sometimes I think a breakout's going to happen, I anticipate the breakout, and it never actually formed, or it never actually broke out.
Sorry to interrupt, but for your breakout strategies, this is something I'm struggling with currently. Is for your patterns, you have it specifically labeled ABCD, breakout, random, or dip buy. How do you is it just any multi-day breakout, intraday breakout, multi-month breakout, multi-year breakout? Are those all included in just under breakout? And dip, what do you consider a dip buy? Is it the morning panic dip buy? Is it where it has a morning spike and then it panics, you dip by that and then anticipate to re-reaching the highs? I have too many categories because I'll see breakout and it's like, well, what kind of breakout was that? Do I want to get really specific? Do I need to know, is it an intraday breakout, multi-day, etc., all the different breakouts? And then I start confusing myself which breakout, and then it's like, do I even need to know exactly which kind of breakout it is? And so I'm left with a whole bunch of tabs and not sufficient data.
Yeah, so that's a good question. So that's where paper trading comes in handy. So the way that I buy breakouts is, again, it's off of the penny stocking framework. So this chart's a great example. I actually traded this one back on the 7th, and I took a 25% profit off of it. And that was actually my goal. I did think that it was going to get stuffed as it got too high, so I placed it because I was actually working off of the previous month's data. So when the breakouts occurred, I also, because I'm a little bit more familiar with ABC patterns, I'm transitioning into breakouts. That's why my breakouts, the consistency as far as where I'm taking profits is inconsistent. So I'm still having a problem trusting the data. ABCD patterns, I can trust that, no problem. I buy into it and I just let it go. So this one right here, it is a former runner. You can see that it had a nice steady uptrending sharp pull back, and it had a breakout right here. I didn't buy into it. I let it kind of do its thing right here. But once this pattern, once it was kind of consolidating, and this is also another thing, I realized that the penny stocking framework is exactly an ABC pattern on a longer time frame. So you can, if you get rid of the left side of the chart, has a nice uptrend, pulls back, moves up, pulls back, but every single time it's making a higher low. So it's an ABCD pattern on a bigger time frame. You see, even back what you're looking at back there, it's the same thing. It's just slowly squeezing itself towards the high. So as it's starting to come up here, I realized, hey, this has a possibility that if it breaks out of this purple line, 0.0065, it has a potential of running. So I ended up buying into it. And let's go to a 5-minute time frame, 5-day time frame. No, it's a little bit further back.
Yeah, because not Tim Grattani, Jack Kellogg, he uses the 15-day, 15-minute, and he'll see the spike, it consolidating. He has him on YouTube and Profitly, and then it's the ABCD pattern, but on a 15-day, 15-minute scale, and then he buys when it breaks or gets the volume and spikes. And so I'm just not sure how you would label that, like multi-day breakout. Should it just be under all breakouts, or?
So I think it depends. It depends on how scrutinizing you want to give your data. To me, if it's consolidating for days, weeks, months, it doesn't matter. It's still a breakout. There's some people who will say, well, based off of if it's consolidating for a few days, it may have a less likelihood of reaching a certain price target, but based off the data I'm collecting, it's going to base it off of a probabilistic thing. So if it's consolidating and it's making a specific pattern, it's still going to follow that same probability. So if it's like, I don't know if you have a ticker, there are some times, let's say it comes up like right here, it comes up, consolidates. I don't want to see that do that. I want to make an ABCD pattern. I want it to actually make a pattern I can clearly identify. So with this one, it's the same thing. It pulls up, makes an ABCD pattern. I can identify that as a trend that I can see. So then I buy into it, and I just let the trade work.
Okay, that makes sense. Yeah, I do have a ticker. I pulled TraderSync up on my phone. The only trade I've gotten filled on this month was April 5th, and it was on LTNC, and I was anticipating a breakout.
Yeah.
And I recognized that the level 2 was really heavy on the breakout level. And I ended up exiting for a small profit. And I just put it as a multi-day breakout because you're on LTNC.
Yep.
So the 5th.
Yeah, so I believe it was this day. I remember seeing that on Twitter.
Oh, you're on 3-minute 1 day. Sorry, I was thinking that was the daily chart. Yeah.
This is the daily chart. This is a 3-month 1 day.
Oh, 3-month 1 day. Oh, okay. I was thinking 3-minute.
Yeah, so for me, and again, when people try to use like Jack's way of doing like the 15-minute time frame, it depends on personality. If a person can look at a 15-minute chart and say, I understand what this information means, go ahead and use it. But for some people like myself, when I'm looking at the chart for a 15-day, 15-minute, I may not see the patterns clearly enough. I like to look at the big picture overall trade. And so when I actually limit what data I'm actually seeing, it may also limit what I can see possible in the market. So for myself, I always look at the 3-month 1 day, 6-month 1 day, 1 year 1 day. And then I start to drill down into like different time frames. If the 15-minute chart will give me an ability like up here, I actually use the 15-minute chart to put down potential support and resistance. So I use the 15-minute chart to get a clear understanding of where support and resistance is more precise, but the overall chart, I want to look at the 1 year 1 day, 3-month 1 day. On average, it's 3-month 1 day is what I'm looking for, because I want to have a shorter time frame. So
yeah, my favorite is like the 6-month 1 day, and then depending on how that chart looks, I'll look at the 1 year, and then sometimes 5-year, 10-year, even 20-year, just to see the history.
See, I used to do the same thing, but what I realized is the further back in time you go, the more manipulation you're going to see. Especially with these cheap penny stocks, they're going to have a lot of, kind of like reverse splits. They're going to actually do a lot more manipulation. And if you want a trade to happen in a sooner time frame, you want to shorten your time frame down. So if I'm looking at a trade that's potential for tomorrow or this week, I want to look at a 3-month 1-day chart. If I'm looking for charts that's potential to swing trade for a couple of days, I want to look at a 6-month one day. So like this is a great example of the penny stocking framework. You actually have the first initial run up down here where it says 1. That's where it got onto my radar. I did buy it up here, and I think I took a loss on that part, just cut my losses quickly because I thought it was going to keep going. It never did, but when it came back and kind of consolidated around this area, that right there kind of told me that there's enough people holding it up. It could be manipulated. I actually don't look at any news. I have no idea why stock's doing whatever it's doing. I have no idea what the sector is. I have no idea what anything is going on because I don't want to be influenced based off of information. I have actually recently, even in the past couple of months or even last month, will buy a stock because there were, I don't remember what the ticker was, but it was a cancer news. And it was like, hey, we got this cure for cancer. The stock spiked like 1,000%. So the next time another cancer play came around with a similar type of news, I bought onto it and held and took nearly a $900 loss. Thinking the last one did this one is going to do the same thing because our brains have the ability to associate with what happened in the past with what's going to happen currently in the future. So once it actually kind of broke out and it hit my price, so down here, you can see where this, I don't know if you can see my little white line there. That's what I consider down here as a breakout. So once it gets above that red bar, that's a breakout. So I didn't buy it right here.
Tough to see without being trained to it because there's so much. Your screen's so busy with all those lines. It's hard to see.
Is that better?
Yeah.
Okay.
Yep, that's better.
So you can see it kind of uptrending. It kind of just consolidates. So if you're looking at this, this is A. So this is the A part right here. B part down here is where the low's at. And as it starts to curl up and make more, C is anywhere within this box. So you could have bought anywhere here and then it ride. I didn't actually trade it. Maybe it didn't hit my radar. Maybe there was something happened. I don't know. I think I actually put my breakout right here because the next day I actually got an alert. I bought it and I sold it up here. And I took, what is this trade? LTMC. I think it was like 50 or something % on it.
That's
what day
awesome.
was that? 329. So that's last month.
That is awesome because shoot, I think I made 2%.
Yeah, 49.8%.
That's awesome. Yeah, I made 2.17%.
Yeah. And a lot of that just comes down to if it's going to break out, there's a chance that it's going to run for multiple days. I mean, Tim Sykes teaches that, some of these stocks can run for 2 or 3 days. Once they run like this one, 1, 2, 3, 4, 5 green days in a row. And I used to think that if this and this was, green, then that also means that there's, that counts as part of 3 days in a row type of rule. Because I have seen it oftentimes where it runs 3 or 4 green days in a row and just cracks down.
Mm-hmm.
But because I'm based off of probabilistic type of probabilities, as soon as it breaks that pattern, that breakout, it can actually keep running. So when it comes up to here, to answer your question, I don't consider that a breakout. Learning what I've learned in the markets, there are people who have the ability to manipulate the markets, like JJ was saying. They'll actually paint the picture of the charts that we see. And because a lot of this stuff is manipulated, oftentimes, like up here, you'll see this consolidation. And I believe JJ said it's kind of like a wash machine. They're trying to wash people out of the trade. So to me, there's no pattern here. There's nothing to tell me that this right here has a higher possibility of going up. But what it does mean is that whoever's manipulating this chart is trying to exit their position. And so what they'll do is they'll end up buying portions and actually bidding the market up higher and higher and higher and higher to entice people thinking, oh, it's going to be a breakout. It's going to actually happen. And so once they get up to a certain point, they just dump all their shares, which is the cause of the fake out. So once it goes up, if this was the breakout, I would actually wait for a breakout, hold back, make the low, and start to uptrend again. That's how I trade my breakouts. I don't buy it all the time right here. I wait for it to say, hey, it's gonna keep going on. But once it broke up, snapped right back, and pretty much went under and over the area of breakout, to me that it's done. It's not gonna keep going. And I think what ended up happening was that they were trying to wash out their position. They were trying to get enough people interested in the stock to actually say, hey, it's possible it's gonna have a breakout, sell the rest of their shares and just let it fade all day. And it's never recovered back.
Yeah, because it looks like this is where level 2 would actually come in handy, because you would see the heavy sellers up there, and yeah, it technically broke out, but essentially it's just a double top or even a triple top up there. If you count that little bit of pre-market action on, yeah, right there. And then you have the panic because people recognize that, oh, the top's in, or the heavy selling like you're talking about, where they're dumping their shares, and then the traders see that it's holding up, so it's like, oh, I'm going to anticipate the breakout. The shorts who got in because of the panic, they're getting scared, because I think it's what T+2, you take your trade then 2 days, and then after the 2 days they can get out of their trade or something like that. I'm not a short seller, so I don't know
that's the rules. It's a T+2 rule. They have a certain amount of time to exit it, but I'm not a short trader. But based off of looking at this chart, I wouldn't short it until it fell that breakout and started around here, because what you want to look for is a breakout chart is an upwards curving direction of the chart. What you have down here, you have it go up, crack, kind of go up, pull back again, and then slowly curl its way up. You can see that down here, just slowly uptrending. And that slow curling action means that buyers have more control, or it also means that manipulators are enticing buyers to come into the market. When it's going up and it pulls back and there's a clear support level right here and a resistance level right there, that kind of, to me, doesn't show any direction of the trade. The pattern doesn't say there's a higher probability of one thing happening. It just means there's something happening. I don't know what the direction is. Now, there are traders who may look at this and go, I can get by this, I can get by this, and if it comes down, I can get by this. To also answer the other question about dip buys, I don't do morning panic dip buys. I'm terrible at them. I actually feel like it's catching a falling knife. Because I do actually have a newborn that I watch. I'm also up until, like, on average 1 o'clock in the morning. I'm getting like 5 to 6 hours of sleep a night. I don't trade it all for the first maybe 30 minutes to an hour. I actually need a little bit of time to wake up, try to have some energy drinks, try to do whatever I can to actually wake myself a little bit more. ABCD patterns do take time to form, so they can take all day to form. I mean, there's some OT swizzles and some of the ABCD patterns that they'll literally consolidate all day into the last hour, and then it just breaks right out. Most of the time, I'm not even near my computer during that time. I'm predominantly a morning trader. I will trade in the morning, place my trade, and I'll just do whatever else. I also run an eBay business from home. That's actually how because I quit my job right before Corona. That's how I actually compensate for my income. And so I do focus on that and taking care of the baby. So that's what I pretty much do. But with this type of a trade, I want to see it come back, make a support, and start to slowly curl its way up. And the more it's doing that, the longer duration it does that, the higher probability it has to actually have a clean, strong breakout. When you're seeing it having red day, red day, red day, red day, red day, it means that there's a lot of people who's selling and there's people who's buying. But you got to ask yourself, who's buying? Like, why are they buying? There's a lot of manipulation, and we're always taught, Tensack says there's manipulation. So you have to have that in the back of our minds that these charts are manipulated. There are people out there in the world that have the capital and the mental fortitude to actually say, hey, I can do this and cause buyers to come in. As a passive trader, which we all are passive traders, means you buy off of a specific pattern, you have to wait for some other person to come into the market and make you a winner or make you a loser. There are dynamic traders out there who have the capital to create the moves, and we need dynamic traders to come into the market and actually push that stock price up. in my belief, there's not enough retail buyers to really push the market up, especially as that was last year and this year. There had to have been big money in there. There had to have been people who can actually make that market manipulation.
Everyone's moved to crypto and Dogecoin to the moon.
That's true. And I do think the reason why we've seen a big slowdown in the markets, a lot of people were anticipating the stimulus checks coming out, bringing a lot of big stuff. I don't think that's why the market's slowing down. People's gas prices have skyrocketed a lot. People like my brother was one of the guys who was trading a lot, didn't really know what he was doing, but made a lot of money. And as he started seeing a shift in the economy, such as he lives in Florida, the gas prices started going up, cost of food started going up. It became harder on them to actually survive compared to a couple of months back. So he actually had to take out his money from the markets to pay bills. And so thinking about that, I know that here in Colorado, where I live, before the gas prices started increasing, we're paying $1.70 to $1.80 per gallon. We're now paying nearly $3 a gallon. So it's almost doubled in gas prices in a very short period of time. So when people are starting to go out and they're actually starting to do stuff, it costs a lot more money than it did several months ago. So I do think that's part of it. Not only that, tax season comes around, a lot of people don't want to put their entire money into the markets. They want to buy their new TVs. They want to go and possibly move. I actually moved from one apartment into a house. So a lot of our tax money went into the move. And so we didn't put it into the market. So I do think seasonality has a huge part to play. This time of year, people are moving and they get their taxes. They want to invest into, if they own a house, maybe renovating their home, maybe buying a new car, maybe buying a big screen TV. We actually bought a big screen TV. So that's why I think there's a lot more slowness in the markets. But at the same time, with market manipulation, before the money started moving from this market and Dogecoin started going up and Bitcoin started going up, you saw big players, Tesla, starting to buy, I think it was like several billion shares into cryptocurrency, and like Bitcoin. They started promoting Dogecoin, which to me means that you can see the money flow. They're creating the market move in the direction what they want. They're going in there because they need retail buyers to take the other side of the trade. That's why they do it. And so it's slow now, but it's going to pick back up, in my opinion. I mean, I've been trading for years, and I do think that the market kind of ebbs and flows all the time.
Yeah, it's cyclical.
Yeah, and in this type of market, it's good to actually to learn a new pattern. It's a good way to actually say the dip buys aren't working as often, or the perception is they're not working as often. I mean, they are working because there's one right here, there's one right here, there's one right here. But I do think when people get into a series of bad trades, they become fearful of taking that pattern. And then at the same time, it's coming down to the recognition of when to take that pattern. Like if you're trying to break out right here, it's not a good breakout. You need that good upwards trend. If it's dip buying anywhere along this area, as long as it's holding this trend right here at a 0702 or 07, to me, it's going to get eaten up, but it's not going to be a good dip. It's not going to come down with the velocity that it may have and kind of snap back up above that. But once it actually cracks that level and it keeps going down, like on this day right here, that would have been a great dip buy. Down here would have been a great dip buy because that's the first time it snapped below a key level. When it snapped down again and gapped down the next day, it popped right back up again. So I'm not a dip buyer, but I can actually recognize that on these 2 days is when I would have actually looked at it. There's just a higher possibility of that happening. So if I was to actually track this, I would have put my alerts here if it drops below that level. And I would have actually put my alerts around like right here if it dropped below that level. And then as soon as the morning happens, because some of these cases it gapped down, as soon as I woke up, I would have gotten that alert, and that would have automatically put my attention onto that stock. And you could have, had several minutes of watching that panic, see the trend on, the change on the level twos and potentially get in. And on this day right here, I mean, I'm not looking at the 1 minute chart, but when I trade panics, I don't trade off the 1 minute time frame. I actually trade off the 5 minute time frame. So what I look for is the first green candle on the 5 minute chart. to me, that confirms the trend change. I may not get the exact bottom, but I know exactly where I'm going to risk off of. On the 5-minute candle, if I was to buy anywhere on this candle, I just place my risk down here. So I can use an OC order on a dip buy pattern. I'll buy it, place my OC order down here. It's either going to work out or it's going to get me stopped out, and I'm out. I don't have to worry about it. So I predominantly, the way that I trade my dip buys is if we were to use this one as let's say a 1-minute time frame, I'd actually wait for it to go parabolic and then just snap, just crack down. It doesn't matter what time of day it is because there's almost always a bounce.
The later day ones, like near the close though, in a slow market, they have way less chances of bouncing versus like when we're in a hot market, you'd get OZSC that would bounce, or that would have a huge panic into the close. But then like 5 minutes, 10, 15 minutes before the close, it would have a huge bounce and you could buy those. But now with like the slower markets, I don't have an example. I just saw it this week actually. Oh, if I had my charts pulled up, it panicked into the close, but there was like no bounce. I think it was ENZC actually that this week. I think that was the ticker, ENZC.
Yeah, I remember this chart. I traded this one.
Yeah, I think it was that day on the left on your top screen.
So like right here?
No, go the other way. It was, I think it was like Wednesday or Thursday. Wednesday.
So that would have been this day.
Yeah, if you look into the close, can you do a close up right there? See how it has all those red
What's the
candles
date
into the
again?
close?
Do you have the date?
No, it was that Wednesday. What was
So
that?
last week, Wednesday is 17th.
Was that what day it was?
Yeah, it'd be. No, today's the 17th. So last week would be the 14th.
Yeah, it's that day.
Okay.
It's right there on your screen on the right side, or I think where it says 10.
Like this part right
no, it
here?
disappeared. Nope, I don't know where it went.
Well, this is Wednesday right here. Sorry, I'm going on to on-demand, so.
Oh, you're on demand? No, we don't need it on demand.
Yeah, because this is what you're talking about, this panic right here, right?
Yeah, that one right there.
Yeah. So the reason why I went out to on-demand was I just wanted to see exactly what day it was. Just easier because I'm a little bit more familiar with that. So this right here, I would have never traded that. The reason why I wouldn't have taken that is that's a panic. It's definitely a panic, and I know that. I believe Kyle Williams and them took that trade. I'm not good at panics. So what I would do is look at the past history of this chart. You can see this back here. It's continuously downtrending. And all it's doing is down.
Well, I love morning or just panics on OTCs. That's one of my best patterns. And like I said, in the slower markets like this, you can get in bigger trouble trying to dip by the panics into the close like this in a slower market versus where we just had 2020 that was really hot, and then the beginning of 2021 where all these traders were creating extremely bad habits that Tim was talking about. And like I think Kyle did dip by this and he got caught in the bigger panic because he couldn't get out quick enough and he had a loss. And I think he talked about it on the steady trade episode, but that's the bad habits that Tim always talks about, where you don't buy or dip by the panics into the close, because that's leading up for the following day morning panic that is more, or that is ideal to dip by that panic. Of course, they vary. but it's the morning panics and kind of the afternoon panics that have potential, the morning panics being the highest odds, and then the panics into the close you pretty much don't want to touch. But I mean, that was just an example of ENZC panicking into the close in a slow market where it doesn't bounce, versus OZSC months ago, you could get away with dip buying the panic into the close. As a matter of fact, I did it a couple times. I think I got stopped out a couple times too soon because Tim was getting after all of us for creating the bad habits. So I just got out. But that's also a shift in the market. And like I said, you just have to be able to recognize a hot market versus a slow market, good habits from bad habits. Because I paper traded for 6 or 8 months back in 2019, I believe it was. And it was such a dead market, but I have that experience to wait for the right setups that I'm looking for. So that's what I've recognized a lot.
Okay.
Oh,
So to answer your question, the panics that I trade are the supernova pullback panic. So on XYSX, I didn't trade this one. I actually didn't even hit my radar until later on. But if it would have ran up and I would have saw this panic and it came all the way back down here, I would have actually bought that. I don't buy them when they're already up and then on the morning they just take a crash or they're consolidating like the ENZZ, and then just take a dip on that. I don't trade those ones because for me, I don't really have a clear area to risk off. I don't really have an idea of where it's going. And because these ones are already having an uptrend and it's a strong volume, to me that means that it's a much higher probability of that dip being eaten right back up again. So these are the ones I do. If it's in the afternoon, let's say you have that stock and it's just continues going higher and higher and higher, and it makes another pullback and it's right around here, I'll still end up buying that. I don't do it often because by the time 12 o'clock comes around, I'm not even at my computer. I'm already done trading for the day.
oh,
So,
okay.
but that's generally what it is. I'll buy those panics. I also based off of previous support levels. So like if it was going up, hypothetically, this chart was going up and it pulled back and it stopped right here, I'd probably end up buying it here, maybe here. But as it starts to go down, it starts to break through key levels on the chart. To me, that means that it's really heavy and there's a lot of big sellers. And you can see that on the level 2s and also over here on the time and sells tape, but there's no real way to determine of how far it's going to keep going. So that's one of the reasons why I'll trade those ones, because the supernova patterns, the faster the movement and the more like consistency that move has, those are the trades that I'm good at. Even before I started using OC orders, I'd be able to take massive probable like gains on those trades because I could ride those up with very little emotion. It's the trades that consolidate, take a long time to move, and don't really know the direction of whether it's going to go. Those are the ones that I have a bit, I guess you can say, anxiety, because I either don't want the markets to take my money away or I want to actually get my price target. So, but yeah.
So you can't be a mechanical trader necessarily with the dip buys.
You can, you just have to be more patient. So you have to have an identifying ability to actually, so like on this trade right here, if I was to actually, let's say this is a dip buy, doesn't matter if it's morning, afternoon, or anything like that. I would actually trade on a 5-minute time frame. So one day, 5 minutes. I've seen Tim Bowen mention this often of where when the dip buy comes in, there's times of looking at the level 2s, yeah, you can gauge the direction of move, but there's no guarantee. There's no indicator in the market, level 2s, VWAP, nothing that's going to tell you 100% certainty of what direction the market's going to move. So what I usually do is I'll wait and I'll see the first time a green bar, a green candle forms in the market and holds. Not the first time it forms, I buy into it, and it has to stay. So the next time frame, so let's say this is a 5-minute, the next one right here, once this green bar is here and this next bar is forming, that's where I buy into it. I place my OC order here, like just below this red candle right here. So I'll be based like right here for my risk, which is probably about 2 to 3% risk. And I'll say based off of, let's say this is it's an OTC, but it's also microflow, and because my OTC currently is 50%, I'll aim for a 50% price target on this. And from that point, to there, it never it never gets you stopped out. So you could easily went from here, you probably would have been out anytime here or doing this pop up, and you do the same thing here. When it pops up, comes down, first green bar, on the second line here, so when this bar forms and holds, you buy here. You place your risk below here, and you just let the probabilities work out, and it's either going to hit your stop or it's going to reach your price target. And on this trade, it's a perfect example. It would have had 2 dip buys that you could have easily made 50% of your money on right there.
That is awesome.
Yeah.
I'm glad you went through and explained that. That's awesome. But it's basically finding that key risk and then just not waiting until your stop is hit. And then you just have OCO orders. So when you put an OCO order in, that's a hard stop, right? So when it's triggered, it automatically gets you out.
Yes.
Okay.
Yeah, it's a hard stop. It's a stop limit order. So as once it hits it, you're out. And
okay, so it's really emotionless because you have no choice because it's placed.
Yeah, it's placed, it's there. And there's no reason to be scared of what direction the market's going to move, because you can say, hey, it's either going to hit my 50% price target or it's going to hit my loss. Either way, I don't really care. Because when people say you got to trade like a machine, well, machines have no emotions. There's no way to take the emotional side of trading out unless you legitimately say, I have to think in a probabilistic mindset. It's just like the casinos. Each hand played, each roulette, spun. They know that on that single game, they don't know what the outcome is going to be. The outcome could be the house wins or the player wins. It's the same thing with stock trading. Either the house is going to take away a little bit of your money, or you as the player is going to take away some of the money. And so by using a mechanical form of trading, it literally makes me the house.
That makes sense. Plus, also when you've seen the pattern a bazillion times, and I would actually say it would be something that a trader has to intentionally want to focus on improving, because there's going to be the degenerates out there who are like, oh, I'm going to buy this, it's going up, and then it's like, oh gosh, I'm profiting, I'm going to keep holding it because I want more and more, and then it panics and it's like, I lost, so I get out. And so they're not recognizing any patterns, and they're just trading what they see going up to the moon, as they say. And versus when you see the same pattern a bazillion times, like 20 years of the same patterns repeating, he knows, like, oh, I recognize this, buy. Oh, I recognize the level 2's heavy, sell. And he knows to keep doing that. When he, like you said, when you recognize your pattern, you see your edge, you have to get in because it's there, because you know that over time the odds of it are gonna ideally make you profitable if you're trading the right setups. And so you don't have the emotion. I'm so to say, I mean, you have the emotion, oh, hey, I recognize that I need to get in. So I can't necessarily say that's greed or fear. It's just, hey, I see it, I need to get in. I don't know what you would call that emotion, but you just buy it, you recognize it.
Well, that's what it is. It's recognition of a pattern. All of us are trading a very specific pattern. And I won't get in, like, if the pattern forms and it goes up, and I'm not going to chase it. But as long as it's within a box, an area where I can say this is where I'm going to risk off of, because that's the thing. If you can't identify where you're going to risk off of before you're entering into the trade, that's a trading error. As the trade's going up and you become greedy and thinking, I want more money, that's a trading error. And for me, if I don't place a stop in the market, that's a trading error. And all these different things are based off of your past, will control your emotions throughout the trade. Like I said, there's some people that have a different self-evaluation. Mariana may be, like, really value herself as a person and say, I'm good enough to make this money. There's other people that, as they're making tons of money in the market, their self-limiting beliefs will come through and will cause them to make trading errors. One of the biggest trading errors that people have is euphoria. They will have a series of winning trades in a row, and for each trader can be completely different. But then they start to increase their size. The size of the trade is one of the biggest reasons why people have a problem counting their losses. They take big losses, they have huge drawdowns in their equity, is because they're not comfortable with that trade. But maybe they had 4 trades in a row, and we go, this pattern is just like this pattern, I'm going to go in with a big position. And it goes a few ticks against them, and that trade that they would have taken on their normal size, maybe $50 loss, now it's a $500 loss. And then they go through a series of mind plays, and they don't know what to do. And so when you're trading, you want to go to a size that is absolutely meaningless. If you're trading with $250 and you're trading an OTC market, and let's say your commissions are 10, 15, 20 bucks for a round trip, if you take that $250 position and you're basing it off of probabilities, you're basing off of what the pattern has a potential of doing. And even if you don't want to go for 50% or 20%, and you go somewhere within that range, over time, you'll be more consistent. And $250 position, you can aim for 20%, and you're taking, 50 bucks consistently, $50, $50, $50. If you're losing, you might be losing $20 plus commissions. So let's say, 30 bucks max. It depends on where that pattern is, but over a series of trades, you're going to become that profitable over and over and over and over again. And that's one of the things, yeah.
Oh, I was going to say, my mom's been watching Extreme Cheapskates. So if you're afraid of losing $10 on a trade just to break even on cutting losses for commissions, you might want to rethink trading a little bit, because there's going to be losses.
Yeah, there's no way to mitigate the losses in the market. Technical analysis doesn't tell us that there's going to be no losses in this trade. All technical analysis does is say there's a possibility of something happening. So when I get into a trade, I don't anticipate a winner. I used to. I used to say this trade has to win. Now I say I just expect something to happen.
That's a great way to think about it, because something is going to happen.
Yeah.
And I think that you talking about this gives something to a lot of traders that they don't necessarily think about. And that's what I do really appreciate talking to you about, is because you really drill it into my head constantly. If your pattern presents itself, you're going to take it, because that's how you trade. And so it makes me feel really guilty when I see that the same pattern and you're like, did you get in? Well, why didn't you get in? It was perfect. It's like, I know. But usually, like right now, we're building a playground for my kid, and I'm not able to just stare at the market. Plus, with it being slower, I'm getting him out into the sunlight that Washington actually has right now. And so I come in and I check the market if I'm lucky, or if I can fit it in every hour, maybe every couple of hours. Plus my mom's on vacation, so we're constantly doing something every day. And so I'm trying to find time to log on to my hotspot and check the market. And I'll see, like on Friday, there were like 3-4 stocks that were just, they had the opportunity, and I missed all of them. And it's just a bummer, because you see it plain as day. I'll go back and I make videos on Profitly talking about it, because I feel so guilty that I got to document it at least. But having that edge of seeing that exact pattern enough times now, because that ABCD pattern that you talked about, I've only been recognizing it for the past couple months, when I've been watching Jack's videos and YouTubes and webinars, and then talking with Mariana on how to improve my trading on it, and talking with you, that I finally have seen so many of them on multiple time frames. That's like, okay, that's the perfect sideways consolidation that you pointed out, that's going higher. I need to buy it. And you mentioned a bazillion times, like, why didn't you get in? That was perfect. And I was talking about, oh, it was a little bit too high for my percentage risk level to be able to take this size. And you're like, no excuse, you should have been in it. And that's exactly right. And now I honestly feel guilty when I'm like 10 minutes late and it's broken out of that consolidation, but I'm not going to chase it, because I have done that. Now, if it goes, that spikes the sideways consolidation, you buy that, that one that you pointed out, and it spikes up. Sometimes it'll perk up like that and then fall right back down for a dip buy opportunity. And I'll snag those up if I make it in time. But otherwise, yeah, if it breaks out of that too high, I just won't chase, because I've also seen where that it'll retest the morning highs or the previous highs, and then it'll fail. So I just won't chase. But when I'm there for it, I definitely try to take advantage of that. Now I haven't been getting filled this month, but
See, with these ones, I don't have a problem with hitting next. If I see my pattern, I have an obligation to be in it.
Yeah.
And because the way that I trade, I don't have to worry about exact timing. I don't have to say, well, I want to get it exactly down here, because I've tried that. I've tried to go, well, the bars are up here. I want to see if it's going to come down here to this area right here and see if I can get a feel. And especially as it becomes longer and longer time frame, you don't know what's going to happen. You can never predict what's going to happen next in the market. So anytime doing this consolidation, I'm going to actually just hit the ask. I'm just going to go, I want into this right here. Now, if it comes out and it breaks out of this range right here, and it goes up higher, I'm not going to chase it.
right. And that's what I mean.
Yeah. And hypothetically, if it comes up here and holds and consolidates, I may get into that, risking off of here. And if it comes down here, I may add into it and place my risk down here. I very rarely add into a trade unless the pattern overall is holding up. So if it comes up, pulls back, makes another high, and on the 5-minute chart, down here, I usually have a 5-minute chart down here, and makes another like higher low, I may average into that one, and then just place my risk down at the same level and just let it ride. But most of the time, once I'm in with the position, that's it. I don't add into it. I don't consistently do that all the time. I predominantly just get into it with the size that I want, put my targets on it. And even yourself, like, I don't know if you saw this one. I actually saw this on one of the videos that you did. I went back and tracked the data because I was watching it as I was actually tracking my data. So if you're seeing this form, I know that you have Thinkorswim. You can use the app on your phone and practice.
Oh, I forgot about that. Duh.
Yeah, just get the Thinkorswim app on your phone, put it on.
I have it on my phone now,
Yeah.
but I forget.
Yeah.
I didn't even think about that.
It has a the chart. So when you see it, I'm assuming you're looking on stock to trade. Just pull out your phone and go into paper trading, which is pretty easy. You just switch your account on the top screen and just place a trade. Whatever size you're comfortable with trading, just place that. You're used to trading $1,000, just buy it for $1,000. And then in there, when you click on it, it'll say close. And then when it says close, it'll say blah, blah, blah. At the very bottom one, I think it says OCO with brackets. On there, the one on the left side is your sell target. The one on your right side is your risk target. So, you can easily say, look, I want to go for a high probability. I want to see this is going to reach 10%. And if you haven't tracked the ABCD patterns like I have, you want to start off with tracking every single pattern you see, whether you're trading it or not. And so just place your OC order down here, and over time you'll start to recognize, well, I got stopped out, the market reversed and kept going in my favor. Well, you'll recognize that perhaps your stop was too close. And then other times your stop is not close enough and you're taking too big of a loss and it just keeps coming down. So generally when I'm learning a new pattern, I will paper trade it first and gather the data at the same time. Then I transition into live money because it's all about execution. Buy this and just let it ride. And that's how you're going to get more comfortable with the pattern, because right now you may be fearful of saying, I don't know if this is going to work. But realistically, we never know what pattern is going to work. So obligated to buy. And I would challenge you this next week or the next 2 weeks, paper trade it. Convince your mind that you don't have to know what's going to happen next in the market. You see the pattern, you identify the pattern, place a paper account, place your OT orders, and go for whatever percent gain you want to get and let it ride. You can literally go and take care of your son, do whatever you want, come back at the end of the day and see what happens.
Well, I would take you up on that, but I've been trading it long enough that I am actually really good at holding it now. as long as I see the trend. But my price targets aren't 50% like yours. What I'm trying to figure out for my journey is I like to buy either into that perk when the volume comes in, or buy that consolidation there, and then risking that level that you were talking about. And then I like to either sell into that first spike there. Yeah, right in there,
Yeah.
when it breaks above the earlier highs. Because if you see on the left side, in the middle of the formation of the pattern before that consolidation, you'll see the highs there.
Yeah, right here.
Yep. I like to sell ideally when it breaks above those highs, because sometimes they can get stuffed. And I'm trying to set my mindset up to sell a little bit into that spike above those highs, and then get into the mindset of scaling out. So yes, I'll take all my shares off into right there to lock in that single, because those singles can be over 10% sometimes. And then I'll think of like, hey, maybe this is where I take some off and then hold the rest for that higher tier, because I don't have nearly the data that you have. But for first and second green days, I've noticed, and I've tracked a bit, that it has higher odds of continuing at least another leg up past that spike. So it'll spike above the highs there, and then it'll come back, consolidate, and then go at least one more time, more times than not. And then I want to sell into that second. Of course, it depends. Has it consolidated all day? Is it getting near the close? Where's it at in the pattern? What's the news? There's 7 different indicators or more that you have to go over to determine how long you're going to hold and sell. But that's what I'm getting used to and working up as my account grows, is holding longer and scaling out. And even I've been studying Jack stuff about even adding along the way, because that's how I'm working to get into that bigger and bigger size, and being comfortable and emotionless with holding as it gets up. Because I'm emotionlessly just locking in those profits, because I know that's my first target. Then I go over in like the video reviews of my plans after I lock in those profits, whether or not I even got to execute the trades, because that's something I'm setting myself up for the future.
Yeah, so the question I have is, why would you sell yourself here when there's a possibility that it can go higher? I can understand,
because I don't want to get greedy. I just want to lock in the first spike, because that's what Jack Kellogg really talks about, is he likes to stay in the money. So he and Mariana too, they like to lock in the first single, and then they'll let more of it right up, or if the pattern presents itself, add. So that's why I want to just immediate lock something in, because they can fail and then I'd cut losses if it failed. But I have at least the robotics of locking in that first essential position, because I'm not going for all or nothing. I want to be able to lock in some along the way, and if I end up getting stopped out, I locked some of it in, because I can always add more ideally in the future. So I'm just trying to learn, just price targets emotionlessly. When it hits it, take that profit, hold the rest longer. It goes to that second spike that I'm used to seeing, lock it in. And then I'll have a smaller position when it does hit that 50% target, because that's my personality. If I'm seeing that it's going up 50%, and it only goes to 49, I'm that person that gets really frustrated that it didn't go that extra bit, and I could have just locked it in. But that's my personality, because my mom is actually a lot like you, where she's like, oh, just hold a little bit longer. It's like say a stock is at 1, it panics down to 50 cents, she's looking for it to reach one again. And I go off of what Tim teaches of maybe 95 cents, because there's going to be a lot of sellers at $1, maybe even 99 cents. So guarantee, I can't say guaranteed because nothing's guaranteed, but increase your odds of at least taking a profit. And that's the way I like to trade, versus where my mom would probably be like you, oh, it's hitting this target, or oh, it failed. I mean, that's just where we differ.
So the thing is over time, I kind of realized that Tim Bertani, Jack Kellogg, they're all the same type of traders. They're all probabilistic traders. The difference is as a newer trader or smaller account traders, there's no way you can actually trade the way they do. Tim Sykes actually had a recent video that I watched that says that a lot of newer traders with small accounts wants to do what they do. We can't add into this position and we can't average out the position because the commissions will eat away our account. So the way to compensate for that is probabilities. They base their same charts off the same stuff off of probabilities. The difference is over a series of years, months, whatever, they actually can say, I know that this chart is going to have a probability of X thing happening. And so Tim will take an average of a 7% gain because he's teaching traders like you and I to be fearful of the markets taking our money away. The problem with being fearful is every downtick that market makes, it contributes into a certain state of mind. And because, like I said, the average trader has beliefs that will control their behavior in the markets. If a person is fearful of the money taking their market away, they will end up having the market take their money away. If they're fearful that the market is not going to go up in their favor, it will end up causing the exact thing they're trying to avoid. So the way that I trade is based off probabilities. I know that this chart has a possibility of doing something. That something is either going to be making my 50% or not. Now, in the future, what I'm going to be doing is as the chart starts to go up towards my target price, I will be actually moving my price up higher, my limit order up higher. So that way, if it does come down all of a sudden, I will get out of the trade with a profit, no matter what. The thing is right now, I need to change my mindset and saying, I don't need to know what's going to happen next to make consistent money in the markets. And so for me, saying I'm going to sell right here, to me, that's fear. It's the fear of going, I don't want to lose money on this trade, so I'm going to exit the trade as soon as I'm in money. Now, somebody like, I know Jack Kellogg does that, but he also has a much larger account. He's going to make sure that he's going to drop a few thousand, few million shares right there. So he's in the money, he has a little bit of cushion, and he can start to play with house's money. And as it comes down and makes another higher low, he may average into that because it's made a support right here. We can't do that. So you can't look at another trader and say, I want to trade like them, because we have nowhere near the mental fortitude, the capital, or the capabilities of doing that. The reason why mechanical trading works, in my opinion, is because over time it takes away the limitations of what the market makes you see available. If I was in this trade and I didn't have OC orders on it, I would be fearful. So I wouldn't be able to see this is an uptrend, this is an uptrend, this is an uptrend. And with the amount of time that they have in the markets and the actual amount of time that they've been trading their pattern, they're confident in what their abilities are and what the pattern's capabilities are. So I know that Matt Monaco was talking to Jack Kellogg and Kyle Williams saying, well, how do I stay longer in the trade? And they were, I don't know if they're teaching them because I wasn't there, but they were probably teaching them just, use the same abilities that you have to enter in the trade and just look at the trend. With the OC orders, it allows you to be clarity of mind, and over time, you'll start to see those trends. So what it does is it actually allows you to learn how to execute your trades properly and do the same thing that Jack Kellogg and all them is doing.
There's actually another thing that I just thought of was Scripts to Trade has actually made an indicator, the trend indicator, I think it's called. I'd have to double check, and it shows the trend of the chart exactly like what you're talking about. And it'll go green if it's still on the long side and the trend is intact and it's going up. It'll go white if it's kind of neutral and it could be iffy, it could be starting to panic down, or it's still in that where traders are like, is it going to go up? Is it going to go down? And then it goes red when it starts showing the backside of the trade, and it's a good indicator to get out of the stock. So like for this one, in the beginning of the pattern, it'll all be green. But when it probably, I think even when it goes sideways there, and I'd have to double check, but it could be have some white in there, but it maybe depending on the volume, I'm not sure exactly how they have it programmed. It could be green to show that uptrend, and then it'll show green all the way up there. And then on the backside, or actually at the top where it goes 0.023 of the high a day, I think that's when it goes white and maybe starts turning red to show that that's the backside. And you should probably end up taking your profits if you're along, because it's a trend change. So that would also do very well with your OCO orders, and probably help with the confidence of staying in a trade longer with that trend indicator.
Yeah, well, one of the things that helps me is purely data driven. So because I know that 2 out of 3 ACV patterns will reach my price target, there's sometimes that it'll get really close, like that one ticker that I showed you before, and it pulled back. That's an anomaly. That doesn't really happen very often. It's possible, but at the same time, I've had it come up here. Let's say if my price target's up here, I've had it run up, pull back, hit VWAP, and keep going. Either that day or the next day, it happens. And it does also determine based off the long-term time frame. Does the chart have a history of multi-day runs? Does it have a history of one and done? Does it have a history of doing whatever? How far is it in the trend already? So I don't take those things into consideration. I base it off the data. It's either going to reach my price target or it's not. There are trades like that I did earlier, like this one right here, where I bought it here on the breakout, it ran up, nearly hit my price target, came down, fell. This one right here, I put a 60% price target and I got the top tick. Nice. And it never came back. Like you can see it right here. I actually got it right there. I don't know why my bubbles aren't showing up. But I bought it as soon as it came out over here on the breakout, let it right up. And there's times where it pulls back, runs up, pulls back. And that right there may cause people to think the trend has changed. I'm fearful. I need to get out. But you don't know what's going to happen. It's holding a support line. So that purple line, if you were in the trade without some sort of possibility of what could happen, every time it comes down, you may think, well, that support line is going to break and I need to get out. But it never did. It never broke that support line.
Oh, sorry. Thank you.
So it never broke that support line, ran up, got me stopped out and played the rest of the time. So, and then this other one right here, there are times where the chart will go beyond where I think it's going to go. I brought the breakout down here and I sold around this area right here, and it pulled back and ramped up and kept going again. I don't care about all this stuff because I don't know that may happen. I mean, most people will look at this and say, well, it came down, hit a support, ramped up, and then pulled back. It also made another support. But I don't know that pattern. And the way that we're taught is there's an infinite number of patterns that have a probability of something happening in the market, but we only have a small percentage of that patterns that we know and we actually have data for. So I'm not gonna do anything that I don't know about because I don't know it. But if I actually know that on this breakout pattern, there's a percentage of something happening, I can get out for 60% gain and let it work. The next day it went all the way up, but I already took my profits and got out. And on this one, I took, and so on this one, I took a 63.64% profit. And for me, all the other traders do the same thing. It's just really hard for them to actually say, hey, this is how I'm able to accomplish that, because it's almost impossible for a person to kind of verbalize an emotion. It's really hard to say, this is how I'm feeling, this is what I'm doing. And you hear a lot of people saying that the trader mindset, trading psychology, is about being aware of what you're feeling and thinking and doing. I actually have a journal that's right next to me that I write on to tell me how I'm feeling in the trade, how I'm feeling in the morning. Do I have a headache? Do I feel sick? Am I tired? And those will actually determine what I actually do. But once I place the OT orders on there, I know that I can place the same size over and over and over and over again. And if I actually have several winning trades, and if I write down before I enter into an order that, you know, this pattern's worked out, I may take bigger size, I can recognize that and say, hey, that's a trading error. Even though I'm not in control of my trades, I know by going into a bigger size, it may make it so that as my trades start to come down and stop me out, I may move my loss. I may, remove my loss from the market, or remove my stop from the market, or let it go further down, which is a trading error. All things that people are going to do in the market is based off of what they believe the market is going to do next. If you think the market's going to do something, you're going to react based on that thought.
Right.
And Tim Sykes is a great teacher. He does teach fear, but I don't think you need to have fear to trade the market consistently. What does make it sense is to actually have data based off that pattern. Tim Sykes teaches the way he teaches, in my opinion, because he knows new traders cannot be trusted to do what's in their best interest.
Exactly.
So I don't think it's bad, but the reason why Jack Kellogg can actually grow significant amounts is because he doesn't trade with fear. He trades with an open mindset, thinking this pattern presents itself. And I've heard him on some of his older things just saying, I'm going to buy into it. And he watched, Dominic's, cut his losses really quickly. And like, you're really good at cutting the losses quickly. It's because you don't have any reasons not to. There's nothing inside of your mental mindset saying, I have to hold on to this. But as other traders, there may be something preventing them in their mental mindset saying, I can't hold on to this. I can't tell my partner that I'm wrong. I can't admit that I'm wrong in this trade. I can't do this. I can't go to whoever's there and say, I'm losing money. So they hold on to it and cause the exact same that they're trying to avoid.
And that makes total sense, because Tim, he deals with a whole bunch of like super degenerate gamblers, and they just want hot stock picks. I gotta have my fix essentially of trading. And so he's like, you got just cut it. If you're not profitable, get out. Because I adopted that in the very beginning, because I had no idea what I was doing. I didn't know what patterns I was looking for. I just knew that when I bought on a first green day, it was going up. So I'd write it up and then I'd lock in a single, because I need to lock something in to just protect myself, because I didn't know what I was doing. And I was doing all this with paper trading. That's why I tracked everything on Profitly, because I wanted to know my statistics, whether it was paper trading or not, so I could see my edge when I began live trading. And so I didn't know what I was doing. I wanted to protect myself thanks to Tim's lessons, and I created those habits until I still use them, but I'm getting more and more experience now where I can wiggle them around a little bit. And you can only bend and break the rules once you know the rules and you've lived by them for long enough to understand what rules you can wiggle with and test and adapt. And I think it's those traders that, like you said, can control their emotions, become more mechanical with their edge. And when their edge presents itself, they obviously take it, and they've been through it so much that they know what they can wiggle with, get away with. They know what they're looking for, that it's just another trade that they've done 1,000, 1,000,000 times. And it becomes emotionless. It becomes a boring old habit, as Tim says. And I think that's what really separates a lot of new traders, the 90% of traders that lose, compared to the ones that are at least consistently profitable.
For any of the watchers out there, this is one of the books that I actually got from Paul and Mark Douglas. It's one of the little known books that they actually have. Most people are familiar with trading in zone. These ones are targeted towards new traders. I recommend to do all the exercises in them. Don't deviate from them. They actually give you a more of a probabilistic mindset, understanding how the markets move, understanding how probabilities actually work. I did actually get as the exact same setup that I actually do, because I follow what they teach to the T, and I just transform that into the way that Tim Sykes teaches. I do think that the reason why most traders lose is because in society, we are conformed by rules. When you get into trading, you have the ability to do whatever you want. Trading is a form of gambling. That's why gamblers who are consistently gambling can make consistent money in the market. It's the same thing. It's a probabilistic mindset. But when people actually want to create rules, there's some sort of resistance to actually saying, I have to have rules in order to make consistent money. And people, including myself, when I first started trading, I didn't want to track my trades. I didn't want to do all this other stuff because you think you're different somehow. And so a lot of people just don't want to do what they know what to do. I mean, Tim Sykes teaches a step-by-step type of framework and patterns that all you have to do is follow that. But we don't want to follow that. We don't want to create a rule set that will actually say, hey, you have to do this or you do nothing. If the market doesn't do a panic buy, you don't buy it. If the market doesn't form an ABC pattern, don't get into it. But people are eager to jump in because they don't want to have any rules in their life, especially in a market where anything goes. And like I said, you don't have to know anything about trading to make a profitable trade. You can literally randomly trade something and you can end up being a winner. And most of us, including myself, I don't know about you, the moment I bought into my first stock, I was profitable. About my second stock, I was profitable. I went 3 or 4 stocks in a row, I was profitable. The market changed, and pretty sure most people who's watching this now started last year, where the market was on fire, and you could have tons of discipline problems, and it's going to reward you for that. But now the market's going back to kind of somewhat normal. I've been around long enough to know that this is still hot compared to what it normally is.
Right.
There used to be one trade a week, one trade every 2 weeks, one trade a month. And now there's at least 1 to 2 trades a day. And so that's pretty still hot. And that's in the OTC market. If there's nothing in the OTC market, it's something in the big caps. So it doesn't matter what price my edge forms, I will trade it. If it's in the sub pennies all the way up to $150, I will trade it.
That's awesome.
Yeah.
And that's great to point out that if you see your edge, trade it, be that mechanical trader. And is there any, I do have a question. Are you on Profitly?
I am on Profitly. Yeah, I'm actually, my name on Profitly is weird. Let me go and log into Profitly and I'll tell you.
Because I figure I'll put in the description your Twitter. Do you want me to put your Twitter handle on the description so that way people can follow you? Okay.
Yeah. So I don't know if Profitly, my username on Profitly is Molamabe.
That's how you pronounce it?
Here. Yeah, it's Molamabe.
Oh, I was like Malone Alabe.
Yeah, it's Molamabe. It's I actually got it from the movie 300. It means come and take it. So, but yeah, it's I'm under Molamabe. I don't know if I'm actually under. I don't know if I actually, no, I'm also under Eric Hargrave, so I do go by my real name and my other name. So if you search me, I'm on there. It actually shows all my trades. Full disclosure, because I have actually been tracking my trades since around 2017. I actually deleted all my old ones because realistically, I wasn't trying to become consistent. I was gambling. I was working full time, studying different things. I also want to get into real estate. I want to get into finances. I was learning how to do stocks. So I was really spreading myself thin. And I just was randomly trading. It wasn't until last year where I tried to become consistent and until I actually found a possibility of actually being consistent, like a pattern and data to make sure that that consistency is there. I deleted everything before, I think it was October or something like that. So there are some drawdowns in my chart, so I'll bring this back over here. So this is me. So I traded 178 times, and these are my losses. And you can see these wins right here. I don't upload every day. Sometimes I forget. I think there's a couple of trades that I have to upload. But if you actually look at my profit chart here, you can see the high consistency. This was back when I started doing it. These times are when I stopped using my OCO orders and stopped using mechanical trading. Wow. Down here, I started using mechanical trading again, and I started uptrend.
That's a huge difference. So now you know your edge.
Yeah, so not only do I know my edge, I also know what's causing the drawdowns. I know that if I follow my plan, I'm going to have losses, but you can see the losses aren't that bad, and then my wins can be bigger. And then as soon as something happens and I violate my rules, I take big losses, and I take big losses, and I just slowly start to grind up again. It's like Mariana said that she's taking $100 at a time, and it's just adding up. So to me, it's the same way. The only difference is I'm not in control of what I'm doing.
Yeah, and you have the statistics to back it up. And so like a year from now, or as long as you keep on doing exactly what you know that works, the baby.
Yeah.
You'll be on your way in no time. So I'll message you after this. I'm not going to post it for a couple weeks probably because I have to post the girls chat, and then so probably in a couple weeks I'll get this posted. Nothing's going to be edited, just again.
Yeah, no problem.
So yeah, you go ahead and finish your slides.
Yeah, so I'm just gonna put these up here. So this is pretty much my way of doing it. I am currently writing a book, though, when that's gonna actually be done. I am a published author already, nothing to do with trading. But this is just basically what I've learned. It is based off of the Mark Douglas methodology for full disclosure. That way people know that I did actually learn a lot from market psychology from him. So this is what I know works for me. And I do think it's going to work for a lot of other people out there because each person has their own self-limiting beliefs. And I do think that 90% of traders lose because they don't have a way to actually make sure that they're conforming to what the market information is. They're too eager to actually be like somebody else, or they just don't want to put rules on at all. There are people that I've actually talked to that are completely happy with being degenerate gamblers. It's fine. But if you want consistency, you have to either take away your emotional state of mind, which mechanical trading does, or you're going to have to actually learn how to deal with the emotions. If you want to actually learn how to deal with emotions, it can take years or decades to do what some of these people have done in half the time. But this is what I do. I also know that Steven Johnson has started using stops. In a way, he's becoming a mechanical trader. And so Steven Johnson has been a really big inspiration of mine because him and I actually started around the same time, and I followed him on YouTube as well. So I actually learned a lot of this because Steven Johnson was disclosing all the information, and I just followed him and started reading all the same stuff that he was doing. And like Mark Douglas says, fear causes us to narrow our attention to the objects of our fear so that we end up creating a very experience we're trying to avoid. Trading with fear will cause you to lose money in the markets because fear will actually make you emotional. You can stay in the mechanical trading form for your entire trading career. A lot of people do it. But what it does is it actually allows the persons to change their mindset to say, I don't know what's going to happen next. I don't have to know what's going to happen next. And transition to more what Temper Tani does and Mariana does. And they're actually an intuitive trader. They can actually use the market information, their own intelligence, to actually determine what direction the market's going to move. The average trader can't do that. And so I think for a lot of new people, start off with mechanical trading. It's hard to actually let the trade do what it's going to do, but it's easy enough to see over time. You don't have to know what's going to happen. You just have your plan, you follow the plan. That's the biggest thing. Most traders don't want to follow the plan. I didn't want to do that for the longest time. My plan evolved as the trading happened, but you don't have to do that. If you have a plan, you stick to that plan regardless of what happens. And that's what mechanical trading is. You're sticking to your plan regardless of what happens.
That's awesome. I need to be a little bit more mechanical too. And I'm slowly working on that because this stuff definitely takes a lot of time, especially because like I want to master my own emotions and be able to personally hold through that so I can take the feeling out of it, get used to that heart racing. Because I think my first trade, JCP and Q, I think it was, I posted it on YouTube. I nailed the ABCD pattern or the swizzle, and I was just sweating. I was excited. You could hear me screaming to my mom when I took a profit. And now it's like, okay, I've seen this before. I know to wait. I know to get my entry. I'm looking for this to happen. I don't know if it's going to happen. This is my stop. I know to get out here. I know where I want to lock in my profits. And that excitement, yes, I have the conviction and it's nice. And it's like, cool, the pattern worked out. I'm learning the pattern, but I'm not like, anymore. It worked. It's like, oh my god, that actually happened. It's like, no, okay, worked as planned. It was just another good one. If it doesn't work, it was just a fluke, and to keep training it. So it's cool that I've been documenting all this stuff since my paper trading days, so that, and talking with traders such as yourself, so that way traders can see the transition of the beginning to when we're millionaires and the steps that we've taken along the way, or not necessarily millionaires, but consistently profitable and have the capabilities of scaling up and growing exponentially.
Yeah, the last thing is I recommend everyone to have a workbook. have a notepad next to your thing. Always track your trades, whether it's an Excel spreadsheet or what you're using. Always keep that data, because that data ultimately is going to help you determine what could happen. But the workbook is basically a mental diary. So every ticker, place the ticker with the date. And if you decide to use mechanical formal trading like I do with OC orders, write down what your thoughts are. Write down if you're thinking about moving your stop. Write down if you do move your stop, right? Because I've actually moved my stop up, like my sell target up, because I think it's gonna go higher. And then I'll write that down and I'll put it right back down to where it was at before. And I've done that several times in a single trade and put it right down. And it's kind of like a mental struggle of what I'm trying to determine. But ultimately what that's doing is it's actually alerting yourself of what things are preventing you from making consistency. I have a problem with wanting more money, or fear of not being wrong on a trade, and fear of saying I have to go and tell my girl that, hey, I lost $600 today. Well, why did you do that? Because I didn't want to cut it. Or I'll make it some sort of excuse of why I didn't want to cut it. You know, this looks like it's uptrending, blah, 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 the news, whatever the case is, write that stuff down. Here, I really want to get out of the trade, but I can't because I have to let it sit there. And you can write it down saying, okay, well, it came back up to here, it's uptrending again. I'm glad I didn't actually cut it. And over time, you're actually seeing the mental state of mind that you have, and comparing that to people like Jack Kellogg and all them, they probably don't have that problem. And so
and they've worked on it
it.
over the years
Yeah.
too, and refined that, because if you look on their YouTubes, they do track all that stuff, like the Daily Trading Coach by Brett Steenbarger. I still need to finish it, but Grutani read that book, and a lot of what Jack does, and he talks with Kyle and the other traders, and he's worked with Dom, where he's been, and Mariana, I guess, was a huge influence from what I've heard him talk about, with keeping him calm and cool about the trades and not getting emotional. So definitely emotions, and tracking how you perform and how you react to this stuff is huge.
Yeah.
So
yeah. And I just have to give credit to Tango Baker on Twitter, because he actually, a long time ago when I was talking to him, he told me to record my voice and my thoughts that way. I thought it felt awkward. I was up, so I started doing it on paper. And when I talked to Paula T. Webb, she asked if I had a trading workbook, and I was like, well, I track my trades, and she was like, well, that's not the same. And all successful traders will track their state of mind as you're trading, because they have to be able to look back and determine what's happening. If you have a breakup in a relationship, that will affect your trading. If you move, if you're traveling, like 10 sites, you travel a lot, that will affect some people's trading. For 10, that's probably relaxing, and that probably makes them profitable all the time. But it depends on the person. Their state of mind will actually determine of how they interpret the market information. Is it negative or is it positive information? And you need to write that stuff down. You need to be able to, when you're reviewing the patterns and what you're doing, also go back and review your trades, because I do it at the end of every week. So tomorrow I'll go through all my trades for the week, determine what I did right, what I did wrong, and I'll also review what my mental state of mind was through my workbook. And you can identify what you're thinking and correct that behavior going forward.
Yeah, who is that name that you wanted to give credit to? It was
Tango Baker.
Okay. Yeah, and I just want to make sure, in case someone wanted to look him up, he got the credit. Yeah, because like last night, I chugged some coffee before bed. I do that on the weekends because I can sleep until about 7:30 roughly. So I was up till 3:30, 4 o'clock this morning, and then up at 7:30 when my son woke up. But I was reviewing charts, and I was posting on Twitter like, hey, I'm studying, reviewing charts. Who else is doing this? Because I want to motivate. I mean, I shouldn't be the only trader up. If you got to put in the work. So I'm showing traders like, hey, I'm a mom, I'm a parent, you're a parent, we're up really pushing ourselves with ridiculously crazy hours, ridiculous amounts of work, because we want it, and that's what you have to put in. And so thank you for giving everyone so much information, and thank you for helping push me to become a better trader, and hopefully I'm helping you a little bit.
Yeah, no, you are. You're actually, you've helped me be able to identify my problem cut losses because you're so quick at doing it. And I will convince myself to hold on to a trade, but I also know how the markets move. I understand there's market manipulation. So it's like, I don't need to be afraid to cut my losses. But the only problem that's preventing me from doing that is how I feel and what I'm thinking while I'm feeling that. And sometimes for myself, it could be same for some viewers, is that it's really hard to go to your partner or your spouse or your wife or whatever and say, hey, I could have cut this. And there's been times in my trading career where she'll come in and she'll be like, that chart looks weak, and she has no idea how to trade. And I'm like, well, you don't know how to trade, so I'm just gonna hold on to it. And I'll make excuses why I'm holding on. And I sometimes will hold on for a day, 2 days, 3 days, cut it for a $900 loss. And she was right. And for some people, it's really hard to admit that they're wrong. For some people, it's really hard to go to their spouse and say I was wrong. Sometimes it's something else in their internal environment that prevents them from doing it. And there's some people like yourself, you maybe don't have that. There's other people like myself, I do. And so, yeah, go ahead.
Okay, so you have troubles cutting losses. I can have troubles holding on longer because, and that's what Tim teaches, and I just like to lock it in. So how you will say, shoot, I forgot her name already. I can't think of it. But is she your wife or your girlfriend?
Allie? She's
Allie.
yeah, she's my fiance.
Okay, so
Yeah.
to your fiance, you'll tell me how you trade her account, which she's doing amazing. You might want to listen to her.
Well, I'm actually, so what happens is I will trade her account. I will place the OC orders on her, and I'm teaching her to trade by me trading her account. What I used to also do was I would place the trade non-mechanically and allow her to exit the trade. I will identify the pattern, she'll exit the pattern. Because I was trying to teach her to become uncomfortable with the emotions. A lot of people, they get into a trade and they don't realize that it's very emotional. And so I'd get into it, she'd do that when she felt comfortable. And I know that most men are more risk averse. They like to take risks compared to women do. That's statistically accurate. And she would actually exit the trade much quicker than what I would. I would actually allow her to hold on. Now, I would actually state that has to do with history and actually being in the markets a lot longer. But it's also a self-limiting belief. I want more money. And oftentimes, if I don't have an OC order on there and I don't have a price target, I may take a profit. And there's times where I've taken a severely huge winning trade and turned into a really big losing trade because I either wanted more, or when it came back down, I didn't want to take less, or I wanted to go back up because I wanted what I was owed. And so,
and this is cool to see because, sorry, here,
yeah,
you finish your thought.
No, go ahead.
Well, because like you pointed out that women, or Allie, she'll be quicker to take profits. Well, so am I. But then for some reason, my mom, she's more like you, and she doesn't have that issue of, I need to get out and keep these profits. But she's also like, I want the more money mentality versus like me, and it sounds like Allie, where it's like, okay, we have this, I want to lock it in, I'm happy with what I have. And so my mom, she'll come in while I'm trading, she'll take a look at my charts and she'd be like, you should hold longer. And it's like, but the bid look, or the ask looks really heavy, and so I should probably lock it in. And so sometimes I should listen to her, probably kind of most of the time I should listen to her, but I'm like, well, you don't know what I'm working on emotionally and what I'm building up to. Like how I was telling you, I want to lock in a profit here and then work on where I would size out and stuff like that. And she'd be like, well, why don't you just hold and take all those profits? It's like, because I'm working on something, just it's okay. And then she'd be like, well, good job, you made a profit. A profit's a profit. And but when I lose, she's like, hey, good job, you knew to get out, you knew to cut the loss, did you follow your plan? But she's encouraging either way. But that's where when Allie comes in, she'd be like, oh, that chart's weak, and you're like, you're not the one trading. And mine's kind of the same way, but the opposite, except for when she says a chart looks strong, and it'll make me kind of, when I'm in the right mindset and not tired or something, I'll take a step back and I'll be like, okay, I'm going to listen to you and I'll reevaluate. This is probably just a pullback and it could go up for a next tier, because sometimes those outsiders who aren't influenced by the market have no experience. They can see a trend that we're too emotionally involved, whether we're mechanical or not, that sometimes it's not bad to take that advice, but use our knowledge mixed with the fresh mindset. And so my mom's actually like you, she's like, hold a little bit longer, and I've done well. But that's where I've noticed, like, my personality, I want to lock in some here. I want to recognize when it's a pullback and to potentially add or hold longer for the next step up. And so that's where it's like, am I going for the profits or am I going for the process? And I
Well,
gotta weigh it.
that's also the same thing. Mechanical trading is process and profits at the same time. If you're looking to actually get into a trade, hold on for the maximum potential of your edge, which is what I'm doing, I'm actually maximizing my edge by saying this is a probability and it's going to either get there. And even if you wanted to scale out of your trade, there's actually type of orders that you can do, which is like there's one cancels the other, which is what I use. There's also like one triggers the other. So you can actually set up multiple OC orders on there. And as it hits specific areas, you can actually scale out your trade, and it's completely mechanical. So like when it's actually doing stuff, like, you know, when you're into a trade and it's going in your favor and you're fearful that the market's going to take that money away, fear causes us to turn our attention to the object of our fear. So we end up causing the very thing we're trying to avoid. So every time it goes up, every red candle that presents itself, it's going to trigger an emotional response. And so if the trend is uptrending and you're going long, every red candle you're going to be like, oh my gosh, is it coming down? Is this just a normal price retracement? Should I take profit here? Should I get out of trade? And as it starts to create more green candles, you become relaxed and you go, it's just uptrending again. And it's the same way with it going down. If it's going down and you're actually losing money and you're like me and you have a hard time cutting losses, every single green candle, you're going to put more emphasis on it's coming back up. It's coming back up. And our humans are designed to recognize patterns. We're easily to recognize patterns. So like you said, somebody who's on the outside come in, they can recognize a trend sometimes better than us staring at the screen, because our emotions will affect how we perceive that information. Is it negative or positive? If it's uptrending and it creates a small pullback, it may just be normal profit takers. It may actually be another support level, but we don't know. But the way that we perceive it is completely different than what the market says. And so that's why I think mechanical trading, it does actually teach the process over profits, because you're actually following plan. It forces you to stick within your range, to stick within your plan, and actually say, I don't have to know what's going to happen. I'm going to do this because this is what my data shows, this is what the pattern shows, and I'm going to develop confidence in what that says. And over time, I'll actually be able to take away the training wheels in essence and trade in a subjective form. That's what mechanical trading does. It allows you to put on training wheels so later on, and I wouldn't say do this for a month, 2 months. Poly2Web gave me a 90-day challenge. And there's still times where I kind of struggle in that challenge. There's still times where I have to force myself to put on an LC order, because we want to be in control of our destiny. We want to be in control of what the market's going to do, but we also have zero control of what's going to happen at all. And it's kind of hard for people to realize I don't have control of what's the outcome of this trade. We believe we do based off of our technical analysis, based off of the news, based off of what we're hearing on Twitter, based on what other people are saying, and they will influence your trading. And you kind of take the risk out of the trade by believing in what they say. And even Tim Sykes says, don't believe the news.
Right.
And so I don't have the news. I don't have the news. I don't have any reason why. I don't have anything other than the pattern and probability. That's it. That's how I trade.
That's awesome. I love it.
Yeah.
And I think that's a wrap.